Good morning and welcome to the June meeting of the EITF. I want to thank all of our EITF members who are able to join today in person or virtually, as well as we have a number of observers that are joining us today, including observers representing the SEC's Office of the Chief Accountant, our Private Company Council, and FINREC as well. So in today's meeting, we have two different issues that we're going to be talking about. First, we're going to talk about the application of the normal purchase and normal sale scope exception to electricity contracts. And then we're going to discuss an issue that was added at the last EITF meeting related to consideration payable to a customer. So for those of you who are watching online, all of the discussion materials are available on our website and include background on all the issues that we're going to be talking about with the EITF today. But before I do hand it over for the discussion related to normal purchases and normal sales, do want to just do a few friendly reminders. For those of you who are joining virtually, please use the raise your hand function if you have a question or a comment that you want to share with the group. Here within the room, please physically raise your hand and we'll get to you in the order of those that have been called on. And if you want to directly respond to another EITF member's observations, touch down, something that indicates that you would like to respond right away would be fantastic. So with that, I'm going to turn it over to the FASB staff who are joining us today to talk about normal purchases and normal sale. So with that, I'll turn it over to Ken first.
Thank you, Hilary. The issue summary for today's meeting highlights background, outreach summary, and alternatives. As Hilary mentioned, that document is available in the EITF project section of the FASB website. Therefore, in the interest of time, we will not tee up in details, and instead we will briefly summarize key points to help frame the discussion. The issue relates to the accounting for certain long-term retail electricity purchase agreements, or PPAs, which are increasingly common as companies seek to secure reliable electricity supply to super power-intensive operations, such as data centers. These PPAs often include features such as long durations, large commitment volumes, and minimum purchase requirements. That can result in the contracts meeting the accounting definition of a derivative. The agenda request noted that measuring these PPAs at fair value could result in earnings volatilities that may not align with the underlying purpose of securing electricity for operations. Entities often look to the normal purchases and normal sales or NP&S scope exception. However, applying NP&S can be challenging for these arrangements, particularly due to the unique characteristics of electricity, which cannot be readily stored in large quantities, and significant uncertainties related to constructions, regulatory contingencies, and future electricity demand. The NP&S scope exception requires it to be probable that a contract will result in physical settlement. There is also existing guidance for certain electricity contracts referred to as the electricity capacity NP&S exception in the issue summary, which reflects the unique nature of the electricity and it provides a tailored application of the NP&S scope exceptions for entities in the electricity industry. However, that exception generally does not apply to retail buyers. Several rounds of outreach have been conducted and included 20 calls with various stakeholders, including preparers in both the hyperscalers and the utility companies and practitioners. The outreach focused on current practice and potential solutions. Feedback indicated that diversity exists in current application of the NP&S scope exception to electricity contract, and that diversity observed in several areas, including a tolerance threshold for net settlements and the evaluation period over which probable physical settlement is evaluated. Now I turn it over to Michael to tee up alternatives.
Thanks, Ken. The issue summary highlights 3 alternatives. Alternative 1 is based on solution A in the agenda request and would be a new scope exception in topic 815 for retail power purchase or sales agreements. Alternative 2 has 2 versions, and will reflect refinements to the current MP&S scope exception. Alternative 2A would establish a quantitative threshold with or without permitted types of net settlement, while Alternative 2B would expand the existing electricity capacity MP&S scope exception to retail buyers. Alternative 3 is a component approach. This approach was developed in response to feedback from the March 2026 education session that several EITF members expressed interest in an approach that could address limitations of the current MP&S model, which operates on an all or nothing basis. If any criterion is not met, the entire contract is accounted for as a derivative. Under approach 3, a single PPA would be separated into multiple components with a portion of the contract accounted for as a derivative and the remaining portion eligible to apply the MP&S scope exception and accounted for as an executory contract. Appendix A illustrates how the component approach would operate and presents the resulting effects on the financial statements. This example is for illustrative purposes only, and the presentation may depend on each entity's accounting policy. EITF members may want to consider whether those financial reporting outcomes would provide useful information to investors. With that, I'll turn it back to Hillary.
All right, thanks, Michael, and thanks, Ken. So first, before we go out kind of more broadly to all EITF members for kind of initial reactions to the different alternatives that were in the issue summary, I wanted to first just kind of reach out to our investor members of the EITF and see if there were any initial thoughts or perspectives when taking a look at the different alternatives and the different information that it would provide from an investor standpoint, whether there was anything relevant that you wanted to highlight before we kind of got into some of the details of the alternatives potentially. So I'll open it up maybe first to investors. Jeremy?
I thought the new component approach was it made more sense. The two main things that I was pushing against with the other approaches were the all or nothing NP&S, but that would result in a derivative contract if you contracted for more electricity than you would need, and also the threshold approach, which would introduce volatility that didn't make sense to me. I thought the component approach was probably the most elegant way to get away from both of those. So I did like how that was laid out.
Thank you, Jeremy. Others, Todd?
I might have a different view. I find the diversity of the component approach might be a bit challenging for users because you can get to very different outcomes in different companies. We've been looking at this extensively because this is a great topic because it really is moving the market. And so I find reducing diversity and having more comparability is a higher rung on my ladder. So I almost feel the other approaches are more appealing, but happy to discuss.
Great, thank you. And David?
Yeah, I'm more in Todd's camp. I think that the other approaches are better, and I personally think that for this type of company and for retail, we're looking at EBITDA and things like this, and I'm not sure that the fair value changes in a derivative are really representative, or not really representative. It's just not the way that we traditionally look at these corporate entities. And so I would prefer it to go through EBITDA and have it come through in EBITDA rather than be a derivative change with a one-time thing. And then the second thing is anything that could cut the work in deciding what is or isn't this, I think is important too, because if some more things snuck in as retail investors that didn't get derivatives, I would be okay with that if it's just running through as a loss in their EBITDA, or if there is some sort of onerous contract or disclosure that says something like that. I think that's what the derivative is going to represent to us. But I worry about changes to derivatives early on and then looking profitable when the actual cash flows are going out the door to pay for these.
Thank you, David. Appreciate that.
If I could just pile on there, I like if you think what investors are doing, you're trying to estimate future cash flows, and I think the derivative counting model almost makes this more challenging. Right. And if we're bifurcating XYZ hyperscaler versus ABC hyperscaler, and you have to go through 3 footnotes to do that. I think that's something we should consider.
Thank you, Todd. Jeremy?
My concern with that, or maybe I'm not understanding it correctly, is that the other two approaches might push everything into derivative accounting in a way that I wouldn't want to see. If correct me if I'm wrong, but if the company enters into a contract that's much greater than its needs, then I mean, if it's all NPNS, I don't think that reflects the underlying economics. And if it's all derivative, I don't think so either.
In Jeremy, I think right with regards to the broad scope exception, that would mean anything that meets like a retail power purchase arrangement would be scoped out of derivative treatment, right? So I think the question is, what would be the definition of the things that are within scope of that scope exception? But I do think there's, something to be said for if entities are entering into transactions at a much greater amount of power than they expect to use in their operations. I think that's a question that we're hearing more of people who are entering into arrangements for what they believe is going to be the amount of power they're going to need for their operations, not in excess thereof. So I would say that I think focusing on alternatives 1 and 2, the intent would be for entities that are entering into arrangements for the amount of power they would need in their operations. The goal would be those would not meet a derivative.
Makes sense. I became concerned after last session by the discussion and also further discussions I've had afterwards about what the industry could look like in 5 or 10 years, where these entities become electricity companies as well. And if those are all running through NPNS, that seems weird.
And Jeremy, completely understand. And I think that that's an important consideration for the EITF with regards to reassessment, right? Thinking about when the contract's entered into, what was the intention of management with regards to expected demand versus how could things change in the future and how would we make sure that the model would be able to be aligned with any changes in that going forward. Yeah. All right, great. Opening, it's a free open up to everybody. So
I
Brandon.
just wanted to ask a question to the investors in what I just heard. Because I keep trying to think of like what we're trying to accomplish. It seems like if the scope exception is broad and gets most of these in, then Jeremy's concern of all or nothing is less relevant. But I think I heard maybe from David about I want to see it go through EBITDA when it occurs, and timing of cash flows, I guess, comes to mind. Is because are you not concerned knowing that in 2 years we're expecting to make some net cash flow payments? Or are you only concerned as these start going off and you have a bunch of them that now it's in your cash flows on a periodic basis and it'll help you estimate what's going to happen in the future? Because it feels like what derivative accounting is doing is it's telling you, hey, there's going to be some net settlements that occur in the future. And if we scope out a lot of these contracts, then do you want information on the estimated amount of net settlements that are going to occur in the period, which you might not have if you don't have any derivative accounting at all?
And I think from my perspective, yes, I just think from like a corporate user, if we're looking at it from this retail lens, I don't think the derivative is the best way to communicate to that investor about the future cash outflows. I think I would love to know the future cash outflows or that they're going to net settle in the future, or that would be out there. I just don't think the derivative is the easiest way for the corporate side to represent that, and the costs and things that come with that, I just don't think are worth, a sentence saying we have this contract for this much product and this is the net settlement expectation. I think that's a much cleaner, faster way for corporate type users to understand. And last time Tom made a really good point about, if I see that derivative, where's the hedge to it? And I thought that was really great, but it's just not the way generally the corporate side of looking at these companies and would look at that, I think. And that's my experience in discussions.
I mean, would you actually see it in the footnote? I mean, where the hedging footnote where we commingle a lot of different exposures. I don't think you would see it.
You could, though. I mean, we're here to do standard setting.
I understand.
You know what I mean?
We're getting into like it powers the number one driving economic force right now. So you could, but you also could not.
Yeah, I was just saying, Todd, I think if you went to a model, if the information you need is contract terms and information relevant to forecasting cash flows or forecasting impact on EBITDA, whatever it happens to be, you could arguably get more information about that through a disclosure requirement as part of this process than perhaps you could get from a single fair value mark that is looking out over 20 years.
Right. And Angie, I think that's a great point, right? No matter what alternative the EITF would recommend, we'd be very interested from a disclosure perspective, what we think is necessary to provide that decision useful information to investors.
I think that's why I kind of found maybe not missing, but a little, maybe we need to focus more on that if we're going to go that other direction, to Jeremy's point. Like, I feel like if we go that alternative, I just don't know if the disclosures are going to be there to support that.
And I think that's fair. And we can certainly talk about that as a group of what would that look like from, the contractual terms, for example, what are the key terms of the arrangements? So appreciate that. Tom? Tom, I believe you're on mute. We can't hear you, Tom. We still can't hear you. Tom, well, we'll come back to you, okay? Just put your hands up as soon as you figure that out. All right. Do we have, Paul, were you? No. Okay. Do we have others who would like to provide some initial perspectives with regards to their, thoughts on the different alternatives? Angie?
I'll go. I guess from a conceptual standpoint, I find the component approach very appealing. From a pure makes sense to break out the piece that I think is going to be derivative versus the piece that I think is going to be normal. So I think from a conceptual standpoint, I like that the best. But I do have real concerns about whether the benefits outweigh the cost. I think the way that the building block, for example, building block 1, is based on an assumption that the derivative layer is expected to be limited, right? So at the gate, getting into the component model, you're expecting the layer to be small to start. And then alongside that, the derivative layer, if I read it right, the derivative layer is the amount probable to net settle. There's going to be very little motivation for a company to conclude that they are probable to net settle. I think that uncertainty is going to perhaps create a situation where that layer will disappear. So I wonder, with the combination of it expected to be limited and probable net settle, whether you'll get any layer at all. And then if you do get a layer, I just question whether the perhaps thousands of components that you're fair valuing over long periods of time, whether that's giving us whether the benefit of that to a user is really worth the cost in the system to do it, support it, assess it, audit it, model it. It seems like a lot, but I conceptually, I think it's the best model. I question whether the benefit outweighs the cost. I think, as it relates to the other two approaches, I do think probably my second best would be tweaking the scope or tweaking NP&S. But I do think that there's a path in a scope exception model where if we write the scope exception right, where we work in some of the concepts about volume being aligned to expectations and perhaps a little bit about what types of net settlements are good or bad. I think if you can get some of those concepts into the scope exception, I think a scope exception could work as well.
And when you say scope exception, are you meaning the broader scope exception,
Yes.
alternative
like
one?
I think we could do either one or
Right.
two in a way that perhaps gets us a little bit more comfortable than just the blunt force of a scope exception, like retail contract scope exception. I'm not sure I love that, but retail contract with some additional caveats about volume and intention and that sort of thing, I think we could perhaps go either way.
Right. And one thing, just thinking about a distinction between alternative one and alternative two, alternative one would be, right, a broad scope exception. So I think we'd have to figure out whether or not that's an optional scope
Optional
group
and reassessments
Yeah.
and that, I think those two things are critical.
versus if it's a kind of
Yeah.
a subcomponent of normal purchase, normal sale. We already have that guidance kind of aligned already with
Yeah,
regards to
that's
it as an
definitely
option.
the
Yep.
more codification friendly.
Just
route.
wanted to highlight that as being a potential distinction. Tom, I want to come back to you to see if,
Yes, hopefully that works now.
yes, we hear you,
Excellent,
Tom.
success. So I guess I just wanted to make an observation maybe for the users. It seems like we need to have a model that's resilient for changes in business models. So while I completely agree when these entities are corporate entities and they're just getting power to support their data centers, fair value accounting doesn't make a heck of a lot of sense. I think the general observation I would have is, we don't know what the future might hold relative to certain of these companies, and they might become a lot more into derivative trading at the end of the day if they don't need the power for their AI, either because improvements in technology or they don't win the AI race, however you want to call it. And in those cases, they'll be exposed to electricity power prices in the future. And quite frankly, I would imagine in those cases, they'll probably hedge it with derivatives. And so this all comes down to the tipping point around when do you want to move from a executory contract to a derivative. And so, in thinking about that, I do think, and we could debate the thresholds, the component approach seems to be the only model that acknowledges that you might be in this midpoint world of you're not completely a corporate and you're not completely an energy trader. While I agree with Angie, there's some complexity. I think the examples were probably overly complex to what I was imagining in practice, because I think oftentimes in practice, people are going to assert that, look, these things were entered into for the sole purpose of delivering physical power. And it's only at the point in time in which, it's clear that you're going to net settle that you begin to account for things as derivatives. Then the question is like, what's the term of the derivatives? And there's basically three different ways you can do it. The simplest way, quite frankly, which isn't really highlighted that much in the paper, is actually using the contractual price. And that makes it kind of easy to deal with. There are proposals in the paper relative to looking at the forward price either at inception or at the date it becomes a derivative. But I think that's the problem with either the scope exception or the binary views in alternative two, relative to this idea that at some point you're going to have a tipping point, and we're going to be constantly debating what that tipping point is for an all or nothing contractual approach.
Appreciate that, Tom. And certainly I think the examples that were included were for illustrative purposes to show how would the model work,
Absolutely.
right? If there were changes, right, in demand. And take your point, that may not happen in year one or year two of a 20-year arrangement, but appreciate that. Kate?
Yeah, so I think big picture, if we think about, is it useful to have a bunch of fair value derivative measurements running through a P&L of a company that fundamentally is not selling that power? I think the answer in my mind is no. And so I think it's just about finding, out of the things on the piece of paper, which are the things that work well from a clarity for investors. And to the point about disclosure, I agree with that. There's probably some disclosure pieces to talk about here. And I think Tom's point, and I think Angie said it as well, around future proofing, this is really important, whichever solution we pick, because we're talking in a world right now where perhaps the hyperscalers are behind what they thought they needed, but the world could change massively and you could have contracts flip the other way around as technology changes. And so I think we have to think about the other option in whatever we pick and make sure that we're not back in this room in 5 years going, oh, it flipped the other way around and now we want to change what we did. I do think, I kind of agree with Angie. I think 3 seems like an elegant read of the guidance, and maybe it's the examples, but that looks really complicated for both the preparer and the investor to understand. And so I was kind of put off 3 by that. I think the broad scope exception in 1, the challenge I have in my head there is what is it about these contracts that is so unique that they get a broad scope exception? And what other contracts, not even in this topic, could then say, okay, well, I need a scope exception, I need a scope exception. So I think there's something just to think about there. If we picked kind of the normal, I would encourage us to pick 2A versus 2B, because I think the capacity contract normal was written based on specifically how capacity markets work. And so I would probably leave that as it is and then think about adding something in 2A.
Thank you, Kate. Paul?
Sorry. It's not going to be the first time though. Just let's be honest. It's one of my many failings. You know, if you go back into the original pronouncements and you think about what the board was trying to do, it's actually a relatively simple concept. If you're buying something that you use in your everyday, you should get a scope exception. And then we started, you know, ratcheting on all these ins and outs and, well, this one feels differently, but I mean, at its core, if it's sort of, this is what I expect to use, then you should get a scope exception. So I actually don't agree. It's conceptually, the component approach is more pure. It feels like something we're trying to engineer. I actually think, and the example in the paper underestimated the complexity that when we get to that point and we actually have to start booking debits and credits, I actually think it's going to get more complex. I appreciate the staff was just trying to illustrate something. I just, you know, my experience in this feels like this is going to get, we're going to start getting Monte Carlo simulations. I can just sort of seeing it. So not a fan of component approach. So then I start thinking about 1 and 2A, acknowledging the point on 2B. So I would take 2B. It feels like we want to solve a couple problems. We want to solve we don't want an exception in perpetuity. So we need to have some sort of reassessment trigger. And I think people will generally be comfortable with that. And that would help future proof. So you could go down 1 and have a reassessment trigger. And we would have to then come up with a threshold of, hey, at some point, if you're selling more than you're buying on a consistent basis, you're out. And that seems okay. You could also do 2A and then come in with allowable net settlements. Like one of the things I struggle with is I think some people sit there and say, well, it's a net settlement. You're speculating. No, you're not net settling doesn't equal speculation. Speculation is something different. And we need to capture what that speculation looks like. And, you know, maybe that's at a 50% where you're now, you know, purposely making a change in your business. And so I could come up with like something on view 1, 2A, I could get there. I would have reassessments. I would have some sort of threshold where you trip on, even on the scope exception. The other thing is, I think this should only be applicable to buyers and not sellers. I haven't heard the sellers, and we've got one here at the table going, I need this fixed. This is at the buyers. The other thing on future proofing, and you know, right now we're using this in the context of hyperscalers, but as capacity shrinks, meaning the availability, more people are going to try to start locking up. And I think we could get this to go to beyond hyperscalers. And again, if they're just locking up their normal electricity use, it doesn't feel offensive. That's what the board originally wanted. And now we got, I don't know how many paragraphs sort of, it'd be a great thing for the board to think about normal purchases, normal sales in general, as opposed to but we got to solve this problem. So I'd be in 1 with some modifications. 2A, I can get there. The one thing I'd be interested in investors, because we've been playing this around, and this wasn't my idea, it was someone else's table. They can take credit if they want. But do you put in a trigger that says, if it's probable I'm going to net settle, I book a liability, like in the near term? So in the next year, if I'm going to net settle something, do you book a FAS5 liability? And just to sort of indicate that, you know, something has happened, you made a decision. And then the flip side, you wouldn't book the gain until, if you're going to receive cash, until it actually happened. So sorry, that was a very long rambling, but trying to where I'm thinking. So.
Yep. Appreciate that, Paul. And maybe Kate, just kind of going back on the whether it be applicable only from a buyer perspective or seller and buyer, just wondering if there's any perspectives that you want to share on that.
Yeah, I would tell you, I don't think there's a significant practice issue on the seller side applying normal as it is written today. There are, I mean, the paper talks about it. There are, I'll call it like practice thresholds that have developed over time, be they percentage net settlements or things like if you had a hurricane or, you know, operational type things that have developed, not codified, but kind of in practice. But I don't think there's a significant issue on that side of it. I would also say, to Paul's point, we're talking about these contracts like they're hyperscaler contracts, but on these types of contracts have existed before, and probably will exist with different parties. Like it would be very common to contract with a large industrial manufacturer coming into your service territory and make sure that they have minimums in their contract too. So I do think your point is valid. We're talking about it like it's data center, but it's probably broader.
Appreciate that. Thank you, Kate. Dan?
Thanks, Hillary. I'll just keep my camera off of a little connection issues here. But yeah, I would echo, I think, a number of the comments that others have made. I really think fair value accounting would be incredibly challenging for these contracts. I don't think it would be represent the economics and what the purchasers of the power are really looking to do with these contracts. Clearly, many of these would be level 3 type valuations, very challenging, a lot of estimation, a lot of volatility. I really don't see what benefit that would provide financial statement users. And we could have some further discussion about additional disclosures instead of derivative accounting that would provide information that could be useful. Certainly trying to predict cash flows and so forth. The components approach, like a number of folks have said, that may be more precise conceptually. It does leverage some existing guidance that's there. But when you look through the worked example in Appendix A, and I agree, that is very complex and likely in the real world it's going to be quite a bit more complex as you go through and adjust each accounting period quarterly. The constant changes and allocation between executory contract and derivative components would be, very difficult to achieve. Maybe some of the hyperscalers with their AI capabilities, might be able to handle it better than most. But seriously, I think it's far too complex. And so I would support exploring the scope exception further. I'm not sure if there was any considerations when we're looking at the capacity contracts back in the day on why we went with normal purchase, normal sale versus an exception but the differences, there might be enough differences there. But yeah, I would think a scope exception, this would be a very strong candidate for a scope exception. If not, I would support alternative 2A, and really looking at, a more sizable amount that could be net settled. The paper talks about predominant and 30%. I think that could be a reasonable level. But I also would echo the thoughts that Paul just made. Just because you're net settling in this circumstance does not mean that you're trading or arbitraging. And so I think qualitatively there could be net settlements that occur that would not be problematic from losing normal purchase, normal sale treatment. Thanks,
Thank you,
Hillary.
Dan. Thank you very much. Brandon?
Yeah, thanks. You can pretty much just put me down for everything Kate said, so she saved me a lot of time. I think the thought process she went through is where I am similarly, is I think we should really explore 2A, and I have questions about 2A. I think there's stuff in there about net purchaser and predominant, but net purchaser seems to be a different threshold than predominant. I'm not even sure 70% is how we use predominant. So we could discuss those thresholds. I think conceptually, very conceptually, I would say 10% is the right threshold, but that I don't think gets the relief. And so I kind of turn to investors at that point. If you're not concerned about 30% net settlements expected at inception, then maybe that's okay. I also have the similar questions that Paul does about, okay, well, how are we going to account for? Are we going to account for at all the expected 30% net settlements that are going to occur in the future? Because I don't think current accounting framework would tell you to account for it in a certain way. I don't think it's technically in FAS 5. I'm not even sure it's a loss contract. So I think we'd have to maybe develop a model if we were going to go down to A. I hear the point on alternative 1. I guess every time I read it, I keep wanting to ask questions that are similarly in 2A. So like there's a concept that you've entered into it to not net settle, or you're going to take physical delivery, and I want to ask a quantitative question about what that means, which 2A explores. So I'm not exactly against 1, but I feel like 1 and 2A will start to converge based on the questions I want to ask about it. And then finally, I guess I would reiterate what Paul and Dan said about alternative 3. I actually think the example is not complex enough. I think it's actually way more complex than what's laid out. I'm actually not even sure it's accurate. I still don't know what to do with the difference in the contractual cash and the hypothetical derivative. I feel like there's actually a difference when you go to settle. And maybe someone else has figured out how to deal with that. It describes annual settlements. These settle daily. I just think it'll be very, very complicated, and I'm not sure, as Paul said, I'm not even sure it is that conceptual. On all the alternatives, I think what we keep struggling with is if you scope it out, most of it out, like how do you account for the thing that is going to net settle? And to Tom's point, how are you going to account for it over time when your expected net settlements increase? For whatever reason, right? We're saying that it's okay. Well, maybe, I don't know, Paul, you're saying it's okay, but like we're looking for, okay, operational reasons might be okay. Well, what if you expect now those operational reasons are going to net settle 100% of the contract? Like, just because it's operational, are you out forever? Because the way in practice it works today is we say trading is bad. Like if you start speculating and trading at all, you're kicked out. And it seems like now we're describing the other way. Everything but trading might be okay. And I'm not sure that is a good model.
Paul, did you want to respond directly to that?
In my mind, operational, like as I think about 2A, I don't know that I put operational in like if it's operational, that probably is, something you would have to factor in. Like I thought 2A was picking up the construction delays, the seller can't produce it, you have a hurricane that comes through, but sort of normal demand, when you're doing the math, that would be would not be in the denominator or the numerator, sorry. And so I would have thought that would have been something you'd have to consider. So that would go into the math, but others might have different views.
Kate, you want to respond?
Yeah, I think the word operational being in that example, it being in the language in here is, I think, the thing that we need to think about. Like if you just think about how normal works today, if you have unplanned maintenance at a power plant, like you don't get, and you have to trade stuff away, you don't count that. So to Brandon's point, we're now introducing something that is a much bigger road to drive down than even what would exist on like normal today. And so I think like if we're going to leave the word operational, we need to better define it as, like, in my mind, it's like a force majeure type thing versus hey, a plant goes down for 2 hours and stuff, trades differently in that period. So I just think that's that word, I think, gave me similar pause in terms of how we define it.
Right. I think to your point, right, if the EITF is interested in approach 2A, what are those permitted types of net settlements? I think we'd have to talk about those because I think in some context it could be, well, there's some amount that has been generally said is okay today, right? Certain events. How much broader do we want to go with that? But that certainly does have an interaction with the quantitative threshold, right? The more things that you say are permitted net settlements, probably the higher the quantitative threshold can be. So there is an interaction there. So appreciate that. Angie.
Yeah, I guess just going back to that exact point, Hillary, to me, and going back to something Paul said at the beginning, if the board's intention was to establish an out with NPNS for stuff that is normal, then I'm more worried about why you have net settlements and less worried about how much they are. So we've practice has said, well, there's an allowable amount, and something that Brandon said too. I feel okay about 10%, maybe who cares? But I would also be okay if it was a higher threshold, provided that the reason that it was higher was because of operational force majeure. So to me, I think the path, whether it be scope exception or 2A, should have that concept contemplated, that the quantities contracted are expected to be consistent and aligned with your usage. We expect like minimal net settlements outside of that. However, right, there could be reasons like operational, commercial, environmental reasons, and that the company expects to get back online as soon as is commercially reasonable. So I think anything, and my vote would be anything we decide on scope exception wording, and we can play with wording, scope exception wording or 2A wording ought to have that overlay. I think we would be missing a big opportunity here to just set a number and say that number's okay versus perhaps setting a smaller number of okay net settlements without layering on the qualitative overlay. Because I do think ultimately the point of the exercise is it's more important of why the net settlements happen than the amount.
Thank you, Angie. Tom?
Yeah, just a couple of thoughts. One is, look, I think any model we come up with, we're going to have to understand sort of where do we want to draw the line on the level of net settlements, right? And I'm talking about either approach 1 or approach 2A, right? Because in those cases, it's all going to come down to a threshold of what's the tipping point. And I think we're going to struggle with that because there's going to be good reasons around why there's net settlements. And there's going to be a question around how do you assert it at day one? And how do you assess it over time for contracts that are 20 years out? And I think that's going to be the struggle. And quite frankly, that's a struggle we have with normal sales today outside of the electricity space. Any long-term commodity contract trying to look out at probability is sort of fool's gold when you're looking out 20 years. So I think there needs to be more of a simplification upfront relative to deciding upfront what was the fundamental business purpose for why you entered into this contract. And in these cases, it is to get the underlying electricity to run your AI. That was the fundamental business purpose, right? And at levels that you expected to be used in your underlying business, not a probability, but sort of an expectation around the reason for it. So I think we need to have that as like a building block in my mind. So we're not in this like projection phase of looking out around what's going to be net settled in the future. As far as trying to look at like what's acceptable net settlements, I don't know. Similar to what Kate said, I don't know what's operational and what's not. Like that's a vague phrase to me. I don't know what's within my control and outside of my control, which I think was also mentioned in the paper. I think that those are going to be difficult models. So I struggle with how we're going to develop a framework around acceptability other than to have a quantitative threshold. But once you have a quantitative threshold for the entire contract, we're going to be caught in this binary outcome that if the quantitative threshold, I'm making it up, is 70% and someone slips to 69, the entire thing is going to go mark to market, right? So I think we need to know that going in, that we're going to have some problems around that.
Appreciate that, Tom. And I think when we're talking about, right, should be an expectation that the levels of, power that are being purchased are going to be, expected to be used for your own purposes, right? I think that's where, some folks might say, well, that is already inherent as part of normal purchase, normal sale, right? So maybe a little bit of an indication of, would you, instead of going a broad scope exception, would you like to keep it in NPNS? Because I do think that's already kind of inherent in that scope exception, is you're going to use it for your business purposes. So just something I think to noodle on. Brandon?
Yeah, maybe final point. I mean, I think Tom made some of these points. I think somewhere in the paper it says that 2A is sort of what we have today, I think is one of the observations in practice. And I don't necessarily agree with that. I mean, I think what we have today is if you fail in any period, you have more than 10% net settled in any period, basically the contract is thrown into derivative accounting forever. So if and we talk about construction delays. So if a contract had a construction delay and it starts net settling in that period 100%, you lose derivative accounting. So I think what we could work on in 2A would actually be very helpful and different than practice, notwithstanding all the questions we have to answer when we explore 2A, how to forecast, what happens when the construction delay is longer than what you estimated. I think it's still a cumulative calculation over like the life of the contract. Because I think the reason, if I'm wrong, I assume Amazon will correct me, but the reason that they didn't like 10% and like 30% was they were concerned by the 10% threshold, which is a little interesting. Like at inception, why do you expect more than 10% net settlements? Do you expect construction delays right when you enter into the contract, or do they sometimes they come to fruition? Are there other net settlements that you expect because you're going to have planned maintenance and those types of things? So I think if we answer a lot of those questions, maybe, that cumulative calculation of the threshold is okay at 10% or at 30%. But I'd rather explore and answer all those questions than just a blanket scope exception that's outside NPNS or component approach, which is very complicated.
Thank you, Brandon. Todd?
I think that's a good point from the user side as well. If you just jump into the pool of fair value accounting because of a construction delay or whatnot, no investor is going to understand how you got there, right? So I do think something a little bit more conceptual, flexible. I think Paul's points were good about reassessing, I think is the word you use. I think that's also beneficial for the users as well. You don't want to go to purgatory just because of a delay.
Angie?
I just throw in one thing on the scope exception side of the house. I do think that there are opportunities to write the scope exception that perhaps can capture some of the comments we're talking about as part of 2A, in terms of, again, aligning contracted volume with expected usage and the types of things that might cause a net settlement. I throw this is not the question we've been asked to answer, so I'll just say that I appreciate that. But there are also some benefits, I think, to scope exception with some other practice issues that are out there. I know from a industry perspective, there can be complications around figuring out if you have a notional. There can be questions around units of account. There's a lot of other questions about derivative accounting in these contracts, where folks spend a lot of time figuring out if they have a derivative to start. So I throw that on, again, that's not why we're here. That wasn't the agenda request, and I get that, but there may be some compounding benefit to having the guidance and the scope exception as opposed to once everybody's passed through the derivative gate. But again, that was not the request. But I just point that out because we may kill a few more birds.
Paul, you want to respond to that?
Yeah,
And
there's a nuance I'm not necessarily understanding. So if you take, because normally when you have a scope exception, you don't have a lot of things associated with it. So if we take view A and then put things with it, what is the difference between that and 2A? No, I'm not understanding the nuance. Because I think step one is if you have this, you're out. Like insurance contracts, we don't add things to insurance contracts to figure out whether you're in or out. We just say if you're in an insurance contract, you're out. That to me is one. If you're going to add things, that's 2A. And the only reason maybe I'm not understanding something. Otherwise, I think we could just sort of migrate the discussion to where we need, as opposed to debating, are we in one with some stuff or 2A? I'm not understanding.
Yeah, and I think to the point that Angie's making, I think when the request for alternative one came in, it was just a blanket scope exception, right? No
Retail
additional
contract.
criteria. Like, let's define what a retail customer or retail, power purchase arrangement is, but not have a bunch of criteria, kind of your insurance scope exception point, Paul, right? I think as we're having this conversation, I think there is, as people get more comfortable around what would an appropriate scope exception look like, I could see how there's a discussion of whether that's in the broad or if that's part of NPNS. But I do think the intention of a broad scope exception was not a bunch of criteria associated with it. Keep it simple so someone doesn't even have to evaluate whether their contract meets the definition of a derivative, versus if you put it in normal purchase, normal sale, you first would have to determine you have a derivative that you then need a scope exception from, right, for applying normal purchase, normal sale. That's how I guess I've kind of thought about that distinction. Kate?
I was going to make a really similar point to Paul, is that we're all focused on the stuff that makes it unique. And so maybe the stuff is what we need to figure out, because if there's stuff, you're not in one, you're in 2A. And so if we don't think just saying retail PPAs out, which is a very broad scope exception, and to what I said earlier, I think in my mind, you're then like, okay, well, what other contracts should we just take out of derivative accounting? Maybe we should just focus on the stuff, because the stuff, whether it goes in 1 or 2A, I think it's going to drive itself to the answer when we figure out the stuff, right? Operational thresholds, et cetera, et cetera.
Yep, agree. Great point, Kate. And David?
Yeah, I mean, there's really good points going through this, and it's just in my head, I don't really have an operational way to say this or a way to operationalize it, but I don't know if it helps that on a, I would say on a contract basis, I'm more okay with it not jumping to a different type of accounting than was originally planned. Like, I understand the speculative nature and these things could change in the future, but it makes it a little bit easier to understand on a contract by contract basis if there was some sort of scope out exception on this contract at this date. This was a normal purchase and sale, and we can reevaluate it and go forward. But it just makes it easier to keep kind of, maybe easier isn't the word, but I could see a path where we understand that the accounting for that contract will remain the same, and that will be, a hit to EBITDA going forward. We could have a disclosure of any net settlements or something like that. And then the next one you're in, you have this assessment, and then maybe you're outside of the scope thing. But I just don't, if their intent, and we all believe their intent is to enter an operational, whatever the word is, contract, and then partway through the contract, they have to adapt in order to make the best economics of this. I understand that a little bit more, versus they're entering these things with an excess capacity that they don't believe that they can handle, and they're going to expect to speculate on this in the future. They see an opportunity, but I don't have a good way to operationalize it. It's just, I think of it in that expectation, kind of the way Paul was describing of what we're trying to eliminate. And because factors change in the future, does that change? Like, if you have some sort of product and you're selling it and you're no longer selling that product, is it other income now? Like, it just appears that this consistent way would be as easy to understand for investors if it stayed consistent over the life of the contract, even if the second half of the contract was more speculative.
Appreciate that, David. Rich?
Yeah, no, I've certainly enjoyed listening to the discussion. Kind of
a couple takeaways I've taken from it so far is it seems like most of the EITF members prefer to account for the contract as a single contract. And then to me, it kind of comes back to, do you think it's more like they're buying power, or do you think it's more like they have a speculative instrument? And there's a lot of discussion on thresholds, but that might be a different threshold, which should just say, in substance, is it more like you're buying power, and just because you can't take delivery and resell it, you have to net settle. Therefore, you're comfortable because you're buying more power than you are potentially reselling, that you put it into one camp. And that excludes all my views on relevance of fair value for something that goes out 20 years when I think it's kind of a swag, but I'll set those aside. But that's kind of what I was hearing from you. So as you get into the discussion of thresholds, that might be something to consider, because you could do a continuous reassessment, and determining what the nature of the requirement to net settle is, why it occurred, that sounds like you might spend a lot of time on that, but I'll be interested to hear the rest of your discussion.
Appreciate that, Rich. And I think that I'm looking around the table, probably would be good to at least just get a vote with regards to those folks who would like to further explore alternative 3. So I'm just looking around the table to see if I can get any hands of anyone who would like to further explore alternative 3 being the component approach.
I started there, but listening to everybody, I understand the unnecessary nature and overly complex. So I'm off that one.
Okay. Tom, I saw your hand up.
Yeah, my observation is I think people are overplaying the complexity with component 3, because I think it could be simplified if you just use the contractual rate of the contract. There's always a question of what's the tipping point for the component approach? Like, when does a portion of the contract become a derivative? I mean, you could debate that. But like, fundamentally, I think with these contracts, as I understand it, for the most part, they're not expecting any probability of an individual delivery being net settled, probably only until the point where it's obvious it will be net settled. And that's probably not a date that's too far out in the future, unless you were going to become a derivative trader like 10 years down the road. So I agree with Rich's point that it seems like people want to head down a path of accounting for the contract overall. I worry about what's the tipping point, that we're going to be debating this tipping point, and we're going to have an arbitrary line drawn in the sand that's some people are going to like or not like. So that'll be the debate we have, I guess. So I would say I'm not personally dismissing component 3, but I understand the alternative 3, but I understand that people don't want to head there due to the complexity, which I think is overstated. But I would definitely support heading down a 2A type path.
Okay. Thank you, Tom. Appreciate that. So I think if we kind of move back from component approach, appears to be off the table for purposes of kind of further discussion from an EITF. I think now we have to kind of focus on, okay, whether it's 2A or 1, I think to Kate's point, let's figure out what we are comfortable with and then figure out where that should go, right? Would probably be a way to think about that. And I think Angie brought up an interesting point for at least you had mentioned earlier, that to you, it's the why of the net settlement that's more important than the magnitude of the net settlement. I think that's an important item to get feedback on from the EITF, because I think that will inform what potential solutions would be. So maybe, Angie, I don't know if there's anything else you'd like to say about that, and maybe get some additional feedback from EITF members on that question.
Yeah, I guess as I've been sort of thinking through it, and Kate made mention of this before, if you've got consumption or generation that is, and I'm going to say temporary, but temporarily interrupted for whatever reason, construction delay, hurricane, maintenance, as a user of the financial statement, and there's net settlements during that period, does that bother me? Does that bother me that I'm still applying normal in that scenario? No, not as long as the entities expect, and we can say expect or probable or whatever, we can debate the threshold, that it will come back online and I still expect to use electricity going forward in my normal operations. Like, that doesn't bother me. So to me, and I appreciate using things like if it's operational reasons or environmental reasons or commercial reasons, right? That we have to sort of struggle our way through interpreting those terms. But at the same time, if I go back and listen to everything we've been talking about this morning, if the fundamental reason you got in the contract was to use it in your normal operations, and there are reasons in those normal operations that caused you some net settlements, I just don't get that worked up about that. And I feel like and I appreciate it's hard, and I appreciate the interpretation around that. But to me, that's the most important piece. And so if we ignore that entirely, then that threshold naturally has to come down, because there's always going to be some of those things. So to me, that's very important. But I appreciate Rich's point that that does throw in lots of judgment, and it throws in lots of decisions to be made about what's okay and not. And maybe it's one of those things is you know it when you see it kind of things. And I know those are really hard things to describe in standard setting.
Appreciate that, Angie. Dan?
Yep, a lot of great discussion. Isn't one of the key things here operationally, and the paper talks about it, we can't store electricity. Like if you could store electricity, then probably you wouldn't have net settlement. It would almost 100% be utilized in the operations. The challenge here is you can't store electricity. That's seemingly unique to this fact pattern. And in my view, that's a reason why you're going to have net settlements, and they're not for trading or speculative purposes. And so we ought to be okay with that. We ought to be comfortable with that.
And Dan, I think that's a great just reminder of why we're all here talking about electricity, right? Is it can't be stored. But Dan, when you say if it's not used for speculative or trading purposes, I mean, is that the threshold that you have, that as long as you can say that the why behind it was not for speculative or trading purposes, you're comfortable with it? I'm just asking a question following on from your feedback.
Yeah, fair question. I mean, clearly those two would set me down derivative path. I don't know that those would be the only criteria, but it does seem to me there's a lot more fact patterns than construction delays, force majeure, and so forth, where we're going to have challenges, and these companies are going to have to net settle because you can't store. And I feel comfortable with that. I don't think that all of a sudden makes the contract, 20-year contract, become a derivative in its entirety.
Thank you, Dan. Appreciate that. David?
Yeah. So, I mean, I agree with Angie on this, the why, right? And so then it's just, what are the whys if we're getting into it? And does anybody have any, like if the why is deemed to be temporary, is that enough to say that it's okay? And then versus, something that's expected to be throughout the life of the contract, would that be the why? Because there's a lot of different reasons in there, right? It could be anything, but what we're really looking for is either they're intending to trade, or there's a change in circumstance and now they have to trade and maybe, or speculate, and maybe those things are different for everybody here. Maybe we look at them differently, but I think that's where we're trying to get to, right? Is to understand what portion of this contract will effectively need to be speculated or net settled in the future versus, but there's also something that pulls both ways at me is, I mean, in theory, they net settle for the cash, right? If this is underwater in the future, we have a derivative liability out there, but they also have the normal purchase and sale contract that's underwater as well. And the accounting's different for those, but the economics are kind of the same from a cash flow perspective, but we'll get different information about them.
Appreciate that, David. I know when the term temporary comes up, my mind goes to OTTI, probably from previous background, which makes me a little nervous with regards to how the word temporary could be used and how much judgment can be associated with whether or not something is temporary. But just food for thought. Kate?
I maybe wanted to go back to something that Brandon talked about earlier. So there's no threshold in GAAP today, right? But practice has kind of made up this 10% threshold. And, you know, you settle out 1%, everybody feels good. You settle out 5%, everybody writes a lot of memos. You settle out 9.5%, you write even more memos, right? And so, but it's interesting. I go back to Angie's point of like, well, is 1% any different than 9.5%? If the reason why I fell out of it is because of something that was, and I'm going to use the phrase I didn't like, beyond my control or operational. And so I think there is, I mean, we're dealing with this issue in practice today. It's just not in GAAP, right? And so I think thinking about the why versus the exact number is probably a better approach. I think we also should think about how does it impact, like we're talking about one side of the transaction here. We should think about how does it impact what exists in practice today and how these contracts have been, or how normal's been thought about on the other side as well. Because, you know, we all got comfortable with, we like a threshold, to your point. Operational's hard, probability's hard. So we kind of all made up this 10%. So just something to think about.
Paul?
Just sort of reacting to what Rich said, and I think we've got an inflection point where we can sit here and say, do you want to look at the contract and think about my expectations going out into the future and think about the contract in total? And as long as, and I don't want to put words in your mouth, Rich, but as long as you still expect to use the majority of the contract for your normal operations, you're sort of out of derivative accounting. But at some point, so that's sort of one approach. So, you know, the other approach is it's almost a dual trigger. Here's a bunch of okay things. And if you have one of the okay things, you pull it out of the math and then you go do math and then you do math at a threshold. I mean, it seems like we've got that inflection point right now where this group needs to sort of figure out, do we want to explore sort of the first one or the second one? Because the decisions around that are then going to be different.
Agree. And I think that's why asking the question of, do we care about the why or do we care about the quantity of net settlements, right? And just getting feedback from the EITF members on that. Because what I'm hearing is we care about the why in the context of we don't want the why to be because it's for speculative or trading purposes, right? That's kind of the, you know, everything, what I'm hearing from other, you know, EITF members is more of, well, you know, I think there could be judgment involved, but I think the one thing we all agree on is if you are net settling for speculative or trading purposes, that feels bad, right? So I guess the question is, do we think that there's kind of to your point there, Paul, like, is that the threshold of the why? We're comfortable with everything unless it's for speculative or trading purposes. And if that's the case, that will allow a lot of things that would be net settlements to be permitted under the model. Do we then need some sort of backstop, right, of a kind of a net purchaser concept, which is kind of what I think I heard Rich going to. So just a reaction. Brandon?
I agree with that, Hillary. And I think the question too comes to mind is the why the new normal? Not to use the word normal, but like, so you know, your data center, the demand for your compute power is significantly decreased. So it's not just like I had to shut it down for a month or something, but permanently going forward, I only need 51% of this power. So in the future, we're going to net settle 49% of this contract into perpetuity. Do we care about that? Do investors care about that? Because the why that drove it was not planned initially, but now it's, and then I didn't want to speculate. I think David said that too, is like, well, I didn't really want to speculate, but I'm forced now to speculate. I'm forced to net settle this contract going forward 49%, just using the, you know, maybe the net purchaser concept. So I think that's something we just need to think about.
Other perspectives based on kind of what we're hearing? Because I think there's, to Paul's point, a decision point here. Do we want to spend time on the why? Or if we think that there's some sort of quantitative threshold that everyone could be comfortable that as long as you're above 50%, right, that is sufficient for us to say that we can live with the reasons for the net settlement above that. Curious, because I do think that's an important decision point. Tom, or sorry, Paul, did you want to respond to that quickly?
Just a process question.
Sure.
are we allowed to frame out two different alternatives for the board and let them expose both alternatives?
I think you could frame it, your recommendation could be the board could explore either or both of these options. The board would have the ability to make a decision if they wanted to narrow, right? So I think if you said we think that either could be acceptable, that would be an option. The board would have to be willing to go forward with putting out two potential ones, or the board could say, we're looking at this and for purposes of exposure, we're going to put out one versus the other and get comments with regards to it. So I think those are all workable from a process standpoint. Tom?
I agree with the observation that if something becomes speculative, right, it feels different to me. I think where we're going to struggle though is what's considered speculative. If I've got, compute power I'm obligated to deliver to someone, and I could deliver it from two separate data centers, and I don't know if that's the case today. And one, I could get a cheaper price by delivering it, lower my cost by delivering it from data center B rather than A, and net settle under data center A. How do we feel about that? Is that a speculative decision, or is that just me lowering my cost? So I worry about us trying to identify like all the reasons that are good and what's considered evil. And so my vote would be just come up with a quantitative threshold, because everyone wants simplification, and live with it.
Tom, appreciate that. And I think, yes, any good or bad list with regards to net settlements, right? That's going to be a negotiation, right? And there's still going to be judgment regardless, right? I don't think
Exactly.
there'd be significant judgment that would be involved with regards to that. And I think we've heard different reasons around the table of what people might be comfortable with, what people might not be comfortable with. So maybe that does take us to a point of thinking about, do we need to get into the business of saying good or bad net settlements? Or is there a quantitative threshold at which we can support that? Obviously, the contract should still be entered into for what you expect to use for purposes of your own, business purposes. That's kind of I think a threshold everyone agrees with is, upfront, that should be the expectation. But is there then a quantitative threshold that we would be comfortable with of, for whatever reason there are net settlements, that as long as they're above that or below that threshold, whichever way you want to think about it, that the instrument could continue to not be accounted for as a derivative. And then we could obviously get into whether there's disclosures and other things associated with that. So maybe I'll come back up to the group. Angie?
I guess I'd just point out, if we think that putting a threshold, a math threshold on it is going to stop the debate, the argument, the judgment, the math, like all that stuff, I think that's short-sighted. I mean, I don't disagree, Hillary, that maybe we'll have less debates about what is operational, what is environmental, the goods and the bads, what's speculative, to Tom's point. Like, we will have debates over that. But we probably shouldn't lull ourselves into thinking that if we just throw 30% on or 50% on or 10% on, then that means, well, that's, follow the math. Like, we know that that's not real life either in terms of the judgments and debates we'll have.
I think that's an absolutely fair comment. By no means trying to undersell, right, that there would be debates with regards to this. And I think that's a question of, maybe that's not a debate on year one or year two, but that will come up as you move further along. And if there's disconnects, right, between what you expect from a demand perspective versus when you entered into the arrangement, right? Fair point. Other thoughts or perspectives of EITF members? Todd?
I get the debate versus principle and quantitative, and we could talk about that all day long. The thing about quantitatives is it's understandable to someone who's not an accountant that's doing all this math, right? You can kind of understand it. And I also think, if you go to the 49%, the market's going to understand that you didn't need half that power way before we get to the accounting. So I think keeping it simpler is probably more value added across parties.
Thank you, Todd. Jeremy?
Yeah, I was going to say something simpler. What I'm struggling with and thinking about it is the decision point, the onset of a contract. If you're locking up future 20 years, the purpose of that, a lot could change. Your business could change, and you might just be securing capacity. You have no idea what you're going to look like in 10 years, and you know that you could net settle or sell. And is that speculative? I have no idea, but uh, it's a hard thing to operationalize, I think. And so in those two choices, I think having some kind of quantitative threshold makes more sense. It's simpler.
Thank you, Jeremy.
I mean, I also think using the word speculative, kind of cuts both ways. You could argue a lot of things are speculative, right? You're trying to secure something that's a scarce resource.
Right. A lot of industries have that, although electricity is not storable, but still.
Other perspectives around the table? So if we're talking about a quantitative threshold, interested for feedback with regards to where members may be comfortable, right? Certainly there has been a substantially all, like a 90% threshold that would have to be physically settled. A 70% threshold, I think, was included in the issue summary. Net purchaser would be, 50.1% would need to be physically settled. Curious from kind of the appetite of EITF members of where you might fall on that spectrum. Paul?
So I think where I fall on that spectrum is impacted by whether I start sort of evaluating and judging activity within a period. And so, like, one thing I heard some people is, as long as if I'm a net purchaser, I'm good. And that's simple. It's quantitative. If somebody then becomes a non-net purchaser, you flip into derivative accounting, but you don't really think about the why. Now, some people seem to want to think about the why. So you could have sort of, I'm going to say view A, just net purchaser. And as long as you're a net purchaser, you're fine. And then view B is, something more at 30%, but then in doing the 30%, you'd kick out things like weather, war, pandemic, delays in construction, power generator can't deliver. But if it's your day-to-day operations, so the point Tom was making about I'm going to source it over here as opposed to over here, that's in the math. And I would put that at 30%. So, like, thinking about at one of those two ways.
Sorry, and Paul, I think your view B, right, which would still have certain sort of net settlements that would not be considered to be a net settlement for purposes of considering this. It sounds to me like you're maybe advocating for force majeure plus a few things, it sounds like.
Sure. I'm not a lawyer, but yeah.
Okay. Which I think is maybe different than others' perspectives.
Because one thing, and I don't think this should influence how we think about this, but we're using net settlements pretty broadly, and how contracts are written for net settlements. Because there's one way, like, I forget the terms, I didn't even look them up, but you can do a true net settlement as I thought I was going to buy, 100 units. I didn't buy 100 units, so I pay 100 units. But then you could also send it out into the market. And if it's, you just get the net, or if it's a bad guy, you have to pay the bet. Like, the net settlement concept is complicated, and there's a lot of different options. And Kate's going to educate us all right now, I think. So.
Well, I think the contracts themselves, right, there's judgments of whether or not, based on the contractual terms, it is a net settlement, right? You have asymmetrical default provision. You have a lot of different potential ways that I think that's always been a question of, is there a net settlement associated with this contract, right? Kate.
I was not going to get into some deep discussion of net settlement, other than saying, I mean, I think that is a big judgment, is what actually is the net settlement. I don't know if that is in the scope of this issue. I go back to that. To me is a whole nother can of worms that isn't on the table for discussion here, but let's assume you get to a net settlement. I do think I'm kind of arguing with myself about, do I want a threshold? Do I not want a threshold? I sort of think I've got to a place where maybe Frankenstein's monster, which is kind of, some things are, I do think some sort of threshold is helpful. And I think that accounts for, I thought Tom's point was really important, that, like, is that speculative? Is that trading? Like, how do you figure that stuff out? So I think maybe where Paul was going is you get a bit of a threshold, a bit of operational factors, and stick it together. That feels like it might be a horrible compromise where nobody is happy, which is the definition of a great compromise.
So, sorry, go ahead, Brandon.
I agree with what Kate just said. I find myself talking in circles as well because if I'm including everything and excluding nothing in the numerator, and then I kind of want a higher threshold. And if I'm excluding things from the numerator, I want a lower threshold because then if I'm excluding a bunch of stuff for you, why are you expecting such significant net settlements? And so I don't know, am I picking a larger quantitative threshold? Well, larger okay quantitative threshold, so 70%, 51%, because I'm not excluding anything. So it's hard to answer your question. It feels like maybe in our next meeting, like we'll be able to explore some of those things. And the other thing I just think about is, I'm doing this at inception, but I'm also reassessing, I think, if we go down to a perspective. So am I excluding things that happen? Do I have that list of things I'm excluding when I'm doing a reassessment? Or am I at inception saying, well, I'm expecting a whole bunch of problems. I'm expecting a whole bunch of planned maintenance. I'm expecting, a hurricane has always occurred, once every 5 years in this area. So I don't know. I'm like asking myself all those questions as I'm calculating this math, this numerator and denominator that I think we need to explore. Because if I exclude them up front, if I say, well, I don't actually expect to net settle anything other than these events that I can't control or that are just going to happen over time, but aren't really for speculation purposes. And am I trying to capture the known? I'm at a point in this contract where I know I'm going to net settle 49% or whatever the threshold is that we pick.
Appreciate that, Brandon. Maybe I'll put just out there, do we have any EITF members that at this point think that they would be comfortable with solely a quantitative threshold? So no additional, these type of net settlements are okay. I'm just trying to get a kind of a survey of EITF members of, do we think there's anyone who's comfortable with a simple quantitative threshold, and we could talk about what that is. I just want to kind of see the options out there.
So this goes back to my question, and you answered it. So I actually would like there to be some sort of public exploration of like the two views that I laid out. Like those are the two that I'm sort of batting in my mind. And Brandon, I don't know that we need to come back to another meeting and sort of debate that around the table. Like I could get comfortable with sort of exposing those two and getting feedback. And I sort of outlined on my 30% option, I sort of outlined, at least in my mind, what I was thinking about you would take out of your math. Brandon, I would do it life of contract. So if you had a hurricane, 2 years ago, I mean, when you do the math, I would sort of factor that in. But so that's where I am, is I'd like sort of public discussion of those two alternatives.
Rich?
Yeah, and maybe one way to think about it is a recommendation could come from the EITF to consider a couple things. And to the extent that the board can't move forward with that information, we could come back to you, right? If the majority of the board thought they needed more refinement. So that's one thing to think about. The other is there's a lot of discussion of what I call force majeure events. And maybe you guys can help me. I didn't think we typically anticipated force majeure events in accounting. And so if I carve all those out, think of it that way, and now go beyond that. So what else would you really like to consider? Because you're not in a fair value model, right? So you're in this expected model, and you could be in an expected model with a threshold and exclude force majeure events. Then decide if you want to consider the construction delays and other things. But just an observation.
Yeah, maybe that's sort of what I was trying to explore there, is like if I took a 20-year contract, you're probably going to tell me that there's a probability percentage for force majeure events, for construction delays, for all those things. Like up front, you're going to tell me there's probability. You might not say it's probable. I think, Tom, when you were going down that point with the component approach, would you ever say that it's probable that a certain delivery is probable that settlement at inception? You're probably going to say that as you get close. And so, yeah, I'm just not sure what we're are we trying to do that math of like a Monte Carlo, a probability assessment of what's the probable amount of net settlements over a 20-year period? Or are we just trying to say, well, all of those things up front are okay. Here's the things that aren't okay. And here's the things that over time, if it becomes the new normal, that it's going to happen that we're not okay with. And maybe Paul, like I already forgot your two approaches that we're going to allow, but maybe after Tom talks, maybe we'll come back to Paul to, at least for me, articulate exactly what we would be asking the board to further explore.
Yeah, I might suggest that EITF recommend prohibiting a Monte Carlo simulation and say it is an expected approach. That is not some hypothetical infinite number.
Right, Tom?
One of the things I guess I'm debating a little bit in my head is this a model in which you just look at the entire contract over its life? Or do you need to consider the remaining contract in making that assessment? So for example, if say the threshold was 30% and you were upfront and you said there's no expectation that I'm going to net settle 30%. But at a later date, let's say 70% into the life of the contract, it's 100% likely you're going to settle the remaining 30%. Do we think that would kick you out or not? In other words, do you look at both the entire life of the contract as well as the remaining portion of the contract, or just the entire life of the contract and doing the math?
And Tom, this is yeah, I think Tom, in the last EITF meeting we had, I think we did include in the memo kind of a discussion of here's examples of if you look at it over the whole contractual life or over the remaining life. Just looking to our team members over here to see if I don't believe we got into that discussion in the last meeting. I think that's something we would have to consider. If I remember correctly, there were some interesting outcomes either way, but maybe I'm looking to the staff to provide a little more detail.
No, I think that's right. We kind of laid out what would happen if you kind of consider it cumulatively or prospectively. So as Tom mentioned, if something happens in the middles, and the outcome potentially differs based on how you measure the actual net settlements that happened in the past, and also considering the future net settlements that you are forecasting.
I think the short answer is this is something that we'll need to put forth, right, with the considerations for what we think makes the most sense from an operability perspective as well. So I think that's a good point. I have Angie and Kate next.
I guess just reaction on the 50%, 30%. I can't explain why, but I feel pretty uncomfortable at 50 for any reason. Like that just to me feels icky. That's not a technical term, but and maybe if I just sat with it for a while, I could get more comfortable with it. But just as a reaction, that feels too low. To me, I guess where I started the day was I sort of liked substantially all with the qualitative overlay, but I completely appreciate that is not the simplest option. So, could I get to a straight 70 as kind of a mitigant as 70 versus 10 plus qualitative? I think I probably could get there.
Thank you, Angie. Kate?
Just on that, that also feels closest to like how this works today, right? Substantially all with qualitative overlay. I was just going to say back to the math conversation we were having. I was not thinking we would math in like a probability of a hurricane or math in like planned maintenance. I was thinking more you get forgiveness when you're doing your math later versus trying to math all of that in. Like, I don't think that is a practical approach.
I think that's fair, Kate. Yep. Brandon?
Maybe to layer on what Tom asked about cumulative and perspective and what Andy just said, like, I'm just wondering, and I think we do need to get feedback on is this operable and is it actually beneficial? But if we had like a substantially all on a prospective basis, then a construction delay is very impactful in the period that there's going to be a 6 months construction delay, but it might not be impactful in the life of the contract on a prospective basis. So substantially all on a prospective basis, excluding mathing in probabilities of planned maintenance and hurricanes and force majeure. Like, I just wonder if that actually does accomplish not getting the volatility that investors don't want on a go-forward basis. Because I think David said early on, like to just have a construction delay for 6 months and say, well, now your derivatives forever, even though you take 100% or close to 100% of the production going forward into your physical operations. So I like the way that Angie, you said that substantially all, because it does feel to me, and I don't, icky, whatever you want to say, is like, so I expect now on a go forward basis that 49% of this contract is going to be net settled, but I'll just, I'll count for that as it happens, even though the contractual price compared to the value of power, I know I'm going to make cash payments for the next 18 years on a regular basis. Nobody cares about that. Now, the all or nothing thing is problematic because you're going to be marking the whole contract, not just the 49%. So how do you feel about the other 51% you are putting in your projection? So I don't know if there's a perfect solution for that, but that is what we have today in derivative accounting. And are we here to really solve that you'll never get volatility that you don't like? Because otherwise we should componentize every derivative or something.
Appreciate that, Brandon. So it does seem like, looking around at EITF members, right? It doesn't seem like we have a majority for any one particular view necessarily, but now I want to we don't have a majority with regards to a single quantitative threshold that can be applied. If I'm kind of looking around table in our virtual participants as well. So it sounds like there is an interest from EITF members with regards to a certain types of permitted net settlements. So now I think it's helpful to get some feedback on what are those permitted types of net settlements, right? I think we've talked about, and Rich, to your point, force majeure, let's just assume that's permitted. People apply it that way today. I think we've heard construction delays is something that I've heard from that standpoint. Help me from other EITF members of other things that you think should be included as permitted net settlements.
The only other one I had was the power generator can't deliver power.
Okay, so, and that is, yes, I take your point of
that. I see. That's where I'm not a lawyer, so I don't know if that's force majeure or not. That's why I don't like the term force majeure. I actually would prefer to give some examples as opposed to relying on that, because I don't know I haven't looked at the legal contracts around that, and I don't know if it's all the same. And so that's why I sort of had a list. I do want to say one thing, like Brandon, you said, looking out 18 years and you're going to make a payment for 18 years, you might not make a payment. You might actually be receiving money depending on the contractual terms. So like, we shouldn't always assume that people are writing checks. They actually might be getting checks.
I think that's a fair point, Paul. And I think we could make an agreement to not use the term force majeure if we don't say Monte Carlo simulation as well. So just we'll leave those out and find other ways to describe it. But I'm looking around the room and our virtual participants to see if there's other types of net settlements that you believe we could describe that should be permitted. Angie?
I was just going to say maintenance.
Okay. Normal maintenance?
Normal maintenance.
Or, I guess maintenance of any kind?
Maintenance outages. I don't know, I'm making that up. I'm looking at Kate. She's like, that's not really a word.
It's, in a way, it's the same thing as saying if the generator couldn't provide, right? Like there's a litany of reasons why the generator couldn't provide. But if we're going to do this, hey, the generator couldn't provide, you probably would pick up planned maintenance outages, like, et cetera, et cetera.
When we say maintenance, maybe we're talking about both, but are we talking about maintenance on the data center? So you can't take power. We're talking about maintenance.
Yeah, that's
on the
kind of how I
power
heard Angie
generator.
was like the power generator, that's their own
Yeah.
maintenance with regards to them would be under the power generator, can't deliver power. But if there's something that the data center itself has to go down for some period and it can't accept power, is that something we also think should be included? Which I think has always been a debate in normal purchase, normal sale.
I don't know
of
if
like
that's a thing
planned
either. I don't know if you
maintenance.
put down
Yeah.
the whole data center to, and stop taking power. You just put down part of it or whatever. And what I struggle too, like even construction delays, that seems okay. But I mean, I know we're talking about 20-year PPAs, but if you had a 4-year PPA in the list of contracts you entered into and it was you have a 4-year construction delay expected now, to just say construction delays are okay. Like, I mean, that's the entire life of the contract. You're going to have to net settle that contract. So how we write this is interesting to me because it's kind of, to me too, is like, how long are we talking this is going to be net settled in comparison to the remaining life of the contract?
I mean, I think that's a good point because there's been semiconductor fabs that all of a sudden it's a cyclical business. We are at the top of the cycle, but all of a sudden you plan for capacity that can't go online. And so I have a fab that sits in Arizona for 8 years.
Right.
Is that a delay? I don't know.
Yeah, and I guess when I sort of think through it, and again, maybe the model starts to get too complicated, but the idea would be, right, that it goes down or it's maintenance or it's a construction delay, but the expectation is that it comes back and comes online and you use whatever, don't use temporary, but maybe use foreseeable future, whatever. I mean, I think we could deal with that because I agreed with Todd, like, right? You don't want to say, well, there was a construction delay and it's going to be 10 years. Like that probably doesn't feel very good. But I think there are in your normal business operations that if it's expected and it's probable that you'll go back to your normal usage pattern, then I don't think I have a problem with that.
So Angie, as you sit on this, you might actually be walking yourself to the one that your word had an ick factor to. Because the scenario you just described, the net purchaser, you'd get kicked out. Like if you had a construction delay that was more than 50% of the life of the contract, you'd get kicked out. So it would solve your problem. The one that you had ick
Still
on.
icky, Paul. Still icky.
Well, no, but remember I said as you sit on it, and so in a week it might not be as icky. Just you're trying to forecast whether you're going to feel icky or not.
Perfect. Tom?
Yeah, I was going to echo some of the comments. I think if we have a test that looks at prospectively the deliveries and your expectations prospectively, and if we were to lower the threshold, I do not believe we need to go answer the question around which are the acceptable and the unacceptable scenarios and change the math. I think we're going to add, it's going to be difficult for us to figure out which ones we like and which ones we feel good about and don't feel good about. So I'm echoing all those conversations. I'm echoing Paul's conversation, but I do believe 50% is too low of a bar. I worry about that. Yeah.
Yep. So Tom, it sounds like prospective and lowering the threshold, but what would be the threshold lowered to? Sounds like it's lower than 90, but more than 50?
Yeah.
Perfect.
75?
Okay, great.
70?
Okay.
Exactly.
Okay.
That's where my head would be, somewhere in that ballpark. Hillary.
Okay. Sounds good. David?
Yeah, I was just going to say that I agree with. I like the prospective kind of way of doing it. That is more, by default, eliminate some of these things that are one time and they come out. And I think that's a little bit easier to operationalize. And I would even, it gets tricky with all these different contract lengths and stuff. But I would even take like a gap long-term version of that quantification. So anything past the initial year, what do you expect out of this contract? That would eliminate a lot of these areas that I think are more, they're not defined, but as, temporary problems, not over the life of the contract problems, would be eliminated. And I think that the perspective covers a lot more of that than trying to make a list or deciding.
Thank you, David. Dan?
Yep. Yeah, I would be supportive of the board exploring the two approaches that Paul had outlined. And from a threshold, kind of my earlier comments, still around the 70% feels like a reasonable level to me. Not knowledgeable on kind of these operational items, but could one way that we have net settlement, let's say, I don't know if these power plants run 24/7 and the demand for power for the data center maybe is less in the off-peak hours. So what if you take 80% of the contract in the off-peak hours, but during your peak hours, you need 120% of what's in the contract? So you're having to buy in the open market the 20% during your peak hours, and during your off-peak hours, you're having to net settle 20%. To me, maybe that could be okay. That could be an operational thing. And again, that's the nature of the beast. That's the nature of electricity, and you can't store it. You're not trying to speculate, but to me, that feels reasonable.
Kate, did you want to respond?
Yeah, I think if you go to the prospective approach, you take out the need to do all of that stuff, because you could have, I think practically, you could have generators running 100% all the time. You could have data centers running 100% all the time. Like, it doesn't necessarily match the peak and the off peak that way. So I think if you solve it through the prospective approach, it kind of probably deals with it. I do think, where we were going before around like, oh, what are all the reasons? I mean, there's 1,000 reasons why a generator could go down, and there's 1,000 reasons why a data center could go down. And I think trying to make a list of these ones are good and these ones are bad is pretty difficult.
Understood. Thank you. Matt?
I was going to say I generally support Paul's two approaches. I do think that the list could be helpful to be able to describe, but I think to the point that Brandon raised, like I question if 90 won't work with the way that we're talking about the math and the perspective and all the rest of that. I mean, I know when we were meeting, I think back in March, one of the examples we were talking about was data centers that went offline in Virginia, like 40 of them on a flip switch because of stability in the power network. And I think that, complicates things, to Kate's point, like what is maintenance? Well, I just flip to backup power and I have to offload this because it's not stable, or you didn't deliver or can't deliver, those types of items. So I think there's a lot of different examples. There's probably good words that we could come up with to give some of those different examples, but I really do question if 90 wouldn't work, with what we're talking about. So, but I don't have a problem with, also exploring like a 70%, threshold as well. I think that's what the original agenda request came in at, and obviously I assume think that works.
Thank you, Matt. And so I'm going to try and summarize, I think, what we're hearing of, interest in a couple of different approaches, I think based on kind of what Paul was saying, but I'm going to put some specifics on here and you guys tell me if I'm on the right track or not. So I think option one would be a quantitative threshold of 90% with certain permitted net settlements. Looking around the room here to see if there's a reaction on the 90% there. I was kind of hearing if we have certain permitted net settlements, which I have a list of, construction delays, power generator can't deliver power, data center can't accept power for some reason, those kind of being a general list. Rich?
And how you think about the math.
Sorry.
Right.
Just a clarification. Is it binary? In other words, that it's either 90 or net settled, or is it 10% net settled? Because what I heard was there's lots of other contractual arrangements that don't meet the definition of net settlement. Would they automatically meet our definition of taking the power? It's just a question. Or are we saying if you net settle more than 10%? And I just asked that because I'm not sure if do you have to take 90? Or do you have to, and maybe it is binary or maybe it's not. But before we vote on the percent or they get feedback on the percent, I was just curious.
Yeah, well,
I was thinking a bit of taking 90%.
I mean, it's getting into the net settlement because it's like if you take it but immediately sell it, I don't know if that's what you're asking. Like, if you take it and immediately sell it, did you use it in your operations? And is that net settlement? We've always thought of that. That's still net settlement, even though you didn't ask the buyer to
net settle it for you in the context of normal purchase, normal sale. But it might be a separate question on what is net settlement, but it does come into play here.
But this is, yeah, I mean, I think we were not kind of relitigating what is net settlement. Looking at the contractual provisions, people have to make a determination of whether or not in certain circumstances that settlement is a net settlement or not. I think to your point, Rich, of if the threshold is 90%, I guess I was thinking of 90% as being physical settlement of 90% of the contract. Physical settlement meaning you're using it for your business purposes, right? Not just you got it, but that you use 90% of the total contracted amount for purposes of your business operations.
I mean, to reiterate what Matt said, like I like the substantially on a prospective basis. I guess I need users to tell me why that's going to result in a lot of derivative accounting for whatever reason. And if it is going to substantially on a prospective basis, excluding whatever we define as those qualitative things that are not expected or planned or whatever the case might be, I'd have to have users explain to me why that doesn't actually get them there. Because I thought, like, well, when the construction delay happens, well, now I'm net settling 100%. I'm concerned in the existing guidance that that's going to make me do derivative accounting on a go-forward basis. So why would we go to 70% if we've accomplished it at substantially all? And then if we learn, no, that's going to be problematic, and maybe Kate, you can already tell me why it's going to be problematic, but that's going to be problematic for whatever reason. We understand what that reason is. So do we exclude those reasons in the qualitative, or do we exclude it in the math by increasing the math to 70%? But I just wouldn't want to go to 70% because we're trying to get an answer without understanding the principle of why we're going further than substantially all.
I think the main thing, right, and I understand, right, the interaction is the tough part here. I guess what I'd like to get a little bit just more clarity on is if we have certain types of net settlements that are permitted, do we want a higher threshold than 70%, for example? Like, do we want
That's
a higher?
my opening bid.
Yeah, great. I think that's kind of the point here, because I do think the main thing, if you're thinking about the certain types of permitted net settlements, the big thing that's not on that list is changes in demand from your customers. That's the big thing. That's what's going to drive this thing not meeting that threshold or not. At least in my view, I think that's going to be the main driver of that, which investors may find informative, right? If your expectation related to what you thought demand was going to be for your data center is significantly different, that may, and maybe Todd or others, if you have a lens with regards to that. But that was what I was kind of thinking of. That's the one thing that's definitely not on that list that would certainly drive how much you're going to be needing to take physical settlement for.
Yeah, and I guess I'd say to that point, Hillary, if you can't take physical delivery because you have no customers to deliver it to, then that's not normal anymore.
Right.
Like, that's not part of your business operations anymore. So I guess, but going back to Brandon, I think I said this a little bit ago, like, I would prefer the substantially all with the overlay. I think, and to Brandon's point, I would like to understand, like, if that's really not going to work, how come? Like, why isn't that going to work? But I do think if I could probably live with going down to 70 for any reason, but less excited.
Yep, I gotcha.
That.
Not ick, but less excited.
Not quite ick. Part of the way to ick, not quite.
So I think we have alternative A, which is a substantially all threshold with an overlay for certain permitted net settlements, as we've kind of described, of construction delays and power generating facility or data center unable to accept or provide the power. And then option 2 would be prospectively applied, but physical settlement of 70%. Is that for any reason? No kind of restrictions with regards to what is resulting in that net settlement.
I think the demand point's a good one. So I don't know if there needs to be like a counterparty analysis as well.
I do think that would be part of
it. Yeah.
Part of the determination of, do you believe that you're going to be needing, right, all of the power that you expect to have. I think that's where all of these get challenging as you get further out in a 20-year contract, right? You may expect that today, but I think that's the importance of kind of the reassessment, right? Is that thinking about that from the purchaser's perspective. Are they going to continue on a prospective basis to be able to support that they expect that they're going to take physical settlement of whether it's 90% or whether it's, 70%, depending on these two different options?
Yeah, and I think to Paul's point, maybe I have a data center and maybe the whole dynamic changes and I locked into a really attractive power purchase agreement. I'm just going to shut the data center down and sell it to someone else. So I feel like that 75% quarter works well.
Okay. So it sounds like we have a couple of thoughts for the board, right, to consider with regards to moving forward on this project. But I don't want to move off of this topic until we discuss disclosures as well, which I think are an important element to this. I know it's a little hard because we have two different thresholds, which could impact the type of disclosure that you're looking for. But I think what we've heard from an investor perspective is they're interested in the contractual terms associated with these arrangements. Is there anything beyond, right, a general disclosure associated with the key terms of the arrangement? Is there anything else that, just looking for feedback of things that the board should consider from a disclosure perspective? Angie?
Maybe net settlements.
The amount of net settlements?
Amounts, reasons. I'm throwing that out. I'm looking at users on whether that's useful information.
Yes,
or not.
It would be useful, yeah. I mean, we're trying to get to the operations of the business, and to the extent that there's a large net settlement in either direction there that is buried in the cost line, it would be helpful to be able to see that separately.
Hillary, not to pick at words, but I was thinking of like impacts and where are they? Tell me, what are the amount of net settlements? Why'd you have them? Where do I see them in the financials? That type of a disclosure.
Okay. David?
Yeah, I agree with everybody on the net settlement. I think it was Paul that brought up that there was settlements in the next year, or, onerous not really the way, but, expected net settlements over the next year for the ones that are really not causing a scope out issue for this, or where it's keeping the normal purchase and sale, but over the next year you're going to have or expect this amount or what you settled in the past year. I think that would be the most predictive information to go forward. Beyond that, I think is getting a little bit far out as far as projected periods.
Thank you, David. Other thoughts, Todd?
I also think the contract terms, but also maybe on a weighted basis. So it's kind of like you read PP&E, and it's like I have assets between 2 and 45 years. You can't do a lot with that. So, I think that would be helpful as well.
Point taken. Thank you. If there are not other kind of perspectives or considerations from a disclosure perspective, just to come back to a scoping issue, we talked a little bit about whether this should be related only to the buyer or whether it should be buyers and sellers. I would put out there an opening bid of having this be limited to buyers only, just looking around to see if there's any different perspectives with regards to that. Not seeing. Tom, are you? There we go. Okay.
Yeah, I'm fine with that. The
Okay.
thing I wanted to highlight was, I think though it would be helpful to acknowledge the practice today around, that Kate was talking to around, substantially all relative to sellers.
Thank you, Tom. Appreciate that. Kate?
I would just say as well, whatever we write down here, you're going to see the other side of the transaction, try and analogize to.
Yep.
Even if we don't scope in the other side of the transaction. So we should just think about that impact as we think about what we're drafting here.
Right. Okay.
Yeah, I wonder if we specifically ask that. right, as
I think
part of
that's
the
fair.
outreach, because for the same reasons this is hard for the buyer, it can also be hard for the seller. So conceptually, I'm not sure why we would necessarily need to limit it, other than appreciate that the question came on the buyer side. So I'd just be interested. I don't know enough about the seller side. I don't really know anything about the buyer side either, but the seller side in particular, I think that's worthwhile feedback to get.
And as we've continued to talk about this, correct me if I'm wrong, but it does feel to me we're talking more about a application of the normal purchase, normal sale scope exception to these contracts rather than a broader scope exception to derivative accounting. Is that accurate? Okay, just for purposes of like how we kind of draft it up and describe it, it sounds like we're kind of working within the normal purchase, normal sale world, but a specific and different scope exception, not tying it to the current capacity contract discussion that we have in NPNS today. Okay. Perfect. Not seeing any other hands indicating a different perspective there. Now I'm looking over at our team to see if there's other, just thinking about what would be the recommendation to the board and kind of building this out further. Are there other things that we think we need to get EITF members' perspectives on at this point?
Does the prospective evaluation cover reassessment or frequency of reassessment?
I guess from reassessment, I'm assuming would be on a prospective basis, but at each reporting period. Okay. Thank you, Nellie.
Just don't use the word quarterly.
We are certainly not at interim and annual periods. Perfect, Paul. Ken?
Maybe just quickly 2 points. Going back to Angie's point, if the scope exception applies to both parties, we heard that sellers may not always have a visibility to the buyer's expectations, how much they're going to use or consumption or forecast. Do you think that additional guidance would be helpful for sellers? That's kind of one point would be helpful. Second one is aggregation. I think we talked about this in last time, whether and how aggregation of contract might be considered. I think we talked about the contract levels or asset or facility levels or more broadly grid level as proposed in the agenda request.
So maybe Andrew, just coming back to, right, we could certainly ask the question of whether or not this should be applicable to sellers, but I think part of it is if you're dealing with the expectation of the buyer, can you really put that on the seller, right? Of being able to in the mind of the buyer forecasting what they think their usage is going to be. So thank you, Ken, on that. And good point with regards to aggregation, right? I think there was a discussion of, right, should that be on a contract by contract basis? Should it be any contracts within, a certain data center versus I think the agenda request had initially said within a grid system, right? Which could be broader than that. So are there thoughts of kind of within that spectrum where we might want to go? Brandon has his take up.
On aggregation, I mean, I think we're still thinking about it as contract by contract. I mean, I guess I'm willing to understand more on what an aggregation would look like. But it feels complicated to me if you're aggregating and then what happens when you have a new contract, different terms. I don't know. It seems complicated to me. And we just do derivative accounting or not derivative accounting typically on a contract by contract basis. And then I guess the other point I would have of something the staff's not asking about, but going back to, I think, our original meeting, it's not clear to me that if we go down this path, why it doesn't apply to normal purchase, normal sale in general, why we would have different normal purchase, normal sale rules, substantially all on a prospective basis, but only for power purchase agreements when thinking about normal purchase, normal sale. I think if it's a good principle, it should be a good principle that's future proof for anyone looking at that exception. I'm assuming the investors would say similar things about the utility of the financial statements of a construction delay for something that's not related to a power purchase, but some other contract that you're marking to market forever, even though it was a temporary impact in a certain period. I just don't know why these principles wouldn't equally apply to any contract looking to apply NPNS.
Yep. And Brandon, appreciate just on the aggregation discussion. I think you bring up a great point, right? If we have a math exercise here, which we have a quantitative threshold in both. Aggregation would certainly make that more complicated. How would that be operationalized, right? So contract by contract, maybe more easier for us to operationalize from that standpoint. And with regards more broadly to if this is a workable solution from electricity contracts perspective, does that give us information that could be decision useful for looking at this more broadly from an NPNS perspective? And I think that's something we've always thought about is first, let's see if we can find a workable solution from an electricity contract perspective, and then determine whether or not that is something that could potentially be extended, right? If we're thinking about that appropriately. So I think those are good points. Other thoughts, other things we should be asking you questions on to get your perspectives on as we kind of further build out these alternatives for the board's consideration. All right. If not, I really do appreciate the excellent conversation today. I think this is not an easy topic. If it were, we wouldn't be talking about it. So really appreciate the different perspectives here. And I think you've given us a lot of information that will be very important for the board to consider and gives us a lot to think about from all of our different stakeholder lenses. So really do appreciate the EITF's work with regards to this issue. And we are going to take a quick break here for, we will feed you. So we are going to give you lunch. And then we're going to have you come back and talk about consideration payable to a customer at 12:30. So, all right, anyone who's joining, please join back at 12:30. Thank you. All right, well, good afternoon and welcome back, everyone. We're here for our double header of EITF issues today. So next, want to switch gears and move over to consideration payable to a customer. This was an item that was added to the EITF agenda at our last EITF meeting. Want to thank Deloitte and Brandon for being the lead EITF member with regards to this issue. And with that, Brandon, I will turn it over to you to tee this up for the group. Thank you.
Thanks, Hillary. So as we discussed in the agenda committee, this issue is to clarify how to initially identify which payments to or on behalf of parties other than a direct customer should be evaluated as consideration paid or payable to the customer. This issue is not intended to address other aspects of the accounting that might come later, including whether or not the payments are in exchange for distinct goods or services. Rather, the focus is really on the first step, is just to identify which payments should be considered within the scope of 606 in general. So we highlighted that the current application does have some diversity in practice that results in different revenue presentations. We highlighted the main industry where it comes up, but it comes up in other industries outside platform companies as well, where entities will include incentives like credits, cashback features, or other rewards to attract and grow an overall user base. So some companies have evaluated the current guidance and they conclude that the incentives to attract and grow a user base may be accounted for as marketing expenses. That's premised on the conclusion that the party receiving the incentive is not actually a customer in the scope of 606. Others view those payments as being made within the scope of consideration payable because the payments are made on behalf of the entity's customer. So in the paper itself, we threw out three alternatives. My recommendation is alternative A. That would be to clarify when the obligation to make payments should be considered part of the contract with the customer. We sort of tracked changes within the standard, but we did point out that we could deal with further changes in drafting of a proposal if we go through alternative A. In general, what alternative A is laying out is aligned generally with former SEC speeches and some that apply that guidance. And it relates to including anything that is either an explicit or implicit promise to the customer that such payments would be made, or the payment represents an in-substance price concession to the customer that has a reasonable expectation that the payment will be made to the customer's customer. As far as the other two alternatives in the paper, The second alternative relates to requiring an entity to evaluate whether the customer or the entity predominantly benefits from the consideration paid. Although we think that alternative could be operable, it certainly would be significantly more subjective in nature, and you may identify items that are not part of the contract that should be, or vice versa. The third alternative is maybe a more conservative approach, which would be that you should consider all payments made to a customer when analyzing this. I think the reason we don't prefer that alternative is it definitely adds unnecessary cost and complexity in our view to the model. It would not even consider why that's being entered into. You could have, contracts that are just in the normal course across a large company that might be with a similar company. Think about, we audit a hotel company, but we also stay at hotels of that company. Like that would be in the scope. You might get to distinct afterwards, but it would increase the cost and complexity of doing so. So I'll pause there and I guess open it up, Hillary, to how you want to kind of seek feedback on those three alternatives.
Sure. And thank you, Brandon. Thanks for a great issue summary and for a great tee-up that kind of walks through the different alternatives. Thought it would make sense to maybe just open it up to the group. Obviously, Brandon has provided recommendation with regards to alternative A, but would like feedback from other EITF members with regards to either questions on alternative A or thoughts or perspectives on other alternatives that want to start the conversation with. Paul?
Brandon, I maybe have a couple questions, but I'm just going to focus on one right now. When I think about View A, I'd say my understanding is View A is supposed to capture what, the firms have published, what the SEC has published, what the TRG may have weighed in. And, one of the things that was sort of missing from View A that I was sort of expecting there to be is there is this notion of, I want to make sure I get the words right, payments made on behalf of the customer, which is language that we've seen in other places. Was it your intention was sort of in the scope of View A? Because right now I would have said, wait a minute, that's a change from what some people are doing because that language isn't there. Was it your intention that language should be there?
It was. I think early in the paper, we mentioned payments made on behalf of customers, but I don't think we carried it directly into the amendments. But that was the intent, that if you are making payments on behalf of a customer, a typical example might be paying to a bank to buy down the interest rate of the customer, that would be in the scope of this issue. And I think it would be good to get it into the standard to clarify, so we're not debating that going forward.
Thank you for that. That's a helpful clarification. Jeremy?
This was written really well, and the one area that I kept stumbling over is in alternative A, the payment represents an in-substance price concession to the customer that has a reasonable expectation that the payment will be made to the customer's customer. And I understand transactions that could have that, but in thinking about platform companies generally, I don't know that describes the credit very well. I don't know that in a rideshare arrangement, a credit that I get is an actual price concession to the driver who is the customer, or that it represents, or that driver has a reasonable expectation. So I was wondering how you thought about those transactions being captured in alternative A, which I think was the purpose of alternative A.
Yeah, open to others' reactions as well. I mean, I think it is principle based, and so it could be interpreted. But I would think in that context that there is an expectation that the driver knows that there's concessions being provided to the customers that use the app and use their services. And that's maybe one thing that we could consider to recommend to the board is there examples that we want to provide in applying this guidance that might help, others apply it in the future to other fact patterns.
The in substance price concession line also was, I don't know that it's a price concession to the driver. They're getting the same amount either way, regardless of whether I use my $5 credit.
Rich?
Yeah. I mean, the challenge with these arrangements, right? You got the credit card company too, right? And is it a credit to the credit card company on your credit card fee, or is it the driver? I thought the key here was making sure people at least looked at those transactions to understand the next step of the model. And right now, my understanding is some argue they don't even have to look at this guidance, if that helps. Because on that example, you know, we could probably debate whether it's an incentive to the credit card annual fee or is it an incentive to the ride sharing?
Yeah, I get it. I mean, I leaned towards alternative C with the question of, in your situation with the hotel, obviously I mean, that makes it complicated, but whether we could make that the default and scope out incidental arrangements like that, or keep it closer to the contract. I'm sure that's what you struggled with when you put this together and how to write it, but that's where I landed in reading it.
Thank you, Jeremy. Angie?
Yeah, I was most attracted to view A2. I think it does a good job of codifying what I think public company practice is already. And I think that is significant because it lowers the cost to implement the guidance, seems practical. People have been dealing with it. And I think, you know, part of the reason I think that the SEC staff landed there is that a lot of the concepts are already grounded in 606 concepts relative to explicit and implicit promises. So there's already conceptual underpinning to it that exists in the current standard, whereas View B introduces some rebuttable presumptions and, you know, who's benefiting and being able to make, you know, who has predominant benefit. I could see lots of debates about there's obviously simultaneous benefit and whose is more than somebody else's and that sort of thing. I think the only thing just in terms of reactions on drafting, and Paul mentioned one of them, maybe another one, is there's a little daylight in my mind between reasonable expectation and reasonably knowable, which I think is the language that the staff had used in their speech. And reconciling those concepts, I think, is a little bit important. Reasonable expectation is the concept that already exists in 606, so it's appealing to keep the words the same. But I do think, and maybe it's more examples, and Brandon mentioned that, but you know, reasonably knowable is a little bit more grounded in, is there information available on which to make an expectation? We don't expect you to forecast every single thing that's going to happen, but is there something out there when you enter into the contract at the reporting date, information available on which to base that expectation? So I do think there's a little daylight in there. So I'd like to perhaps play with that a little, and maybe that's more words, maybe it's examples, maybe it's illustrations. I don't know what it is exactly, but I do think there's a little daylight there that might be worthwhile to probe on a little bit.
Thank you, Angie. Paul? So
I've actually given this a little thought, and I am very interested in the reaction around the table. And I dismissed B. I didn't like B, so I took B off the table. The thing that sort of gave me pause as I was going through the materials again yesterday is, you know, we spent the better part of a decade trying to drive practice using words around that were in alternative A, and we still got diversity. And so by codifying A, what are we doing differently that's going to get rid of the diversity? Are we still going to have the fights, if you will, about what those words mean? And, you know, we struggle in the US, struggle even more outside of the US. I mean, like, we think we've got diversity here. Outside the US is even, you know, significant diversity. And I would encourage IFRIC to take up a project immediately because they have a bigger problem than we do. But I don't have oversight over that. So, so then I started playing around with C, and I was like, okay, does C make it more costly or less costly to implement. And I could think about that on both sides of the coin because I'm getting rid of a test. And I think distinct is going to kick out all the ones that you're worried about. So like your example about the hotel and the audit, I mean, it's going to take you 2 seconds to get through distinct on that one. And so do I lower my costs by getting rid of a test that at least for the last 10 years has been ambiguous, because we do get into these conversations, and I mean, the conversations are typically, well, you really can't mean that's what the standard says. And we're like, no, it is. And then we talk about, the SEC staff speeches, the pre-clears, the TRG and everything. And so I was just, and at some point I'm going to have to make up my mind, but sort of bouncing between A and C, because I think there is an argument that C actually makes it easier. But it relies on distinct. And so we have to be comfortable that the stuff that would get kicked out in A would still get kicked out in C.
Appreciate that, Paul. Tom?
Yeah, I'm supportive of alternative A. I think for the reasons that Brandon expressed. I think alternative B is too judgmental. To Angie's point, I wouldn't provide any incentive if I didn't benefit from it. So now I'm debating who benefits predominantly. I think it would be a difficult analysis to take. I hear Paul's point on alternative C, but I am worried that there will be unintended consequences. I also believe that any incentive that exists, someone would have to go through and document the distinct requirements. So I actually think it would create more work than alternative A. I do think, consistent with what I think Angie had mentioned, I think it would be helpful if we either had examples of illustrating, reasonable expectation and implied, or at least having some factors to consider. I mean, some of the things that I think people have looked to in practice is around reasonable expectation is the incentive tied to the same underlying in the transaction that generates revenue? Is there a past practice? Is it known or knowable? As Angie suggests, that's been one of the factors. So for example, is it broadly marketed? Was it sort of discussed during the entire sales process? Is there reporting to the customer of the incentives used by their customer? For example, that might be helpful as well. And then when it comes to implied obligation, I think people look to things like, and maybe this is part of the known and knowable, but it's sort of the question around what was your customer aware, what was your awareness of the incentive program? And is there, not linkage to the transaction? And does the entity have discretion over changing the incentive over time? And I would have no ability to alter that, for example. So those are some of the things that we had kicked around.
Thank you, Tom. Appreciate that. Others that have feedback based on what we've heard so far? Jeremy?
Do you have examples for alternative C that you'd be concerned about, aside from something incidental like the hotel, like in an actual transaction?
I don't think it's a concern with the end results after going through all of the work, because I think you'd get to distinct. For me, it's a little bit of, and maybe it's, what is auditors going to ask the companies to do to comply with View C of show me all payments that are being made to one of your customers, regardless of whether it appears to be linked or not, or negotiated at the same time. So to me, it's a little bit of it, to do all that work, as Tom say, isn't that more costly to get to the same results? Because if you're having to search for it, it's probably not related to the customer transaction, but don't you have to now search for it from a completeness perspective to do the analysis?
Do you think that alternative A as written and alternative C would get to the exact same result?
I most likely it would get to the same revenue result, but in a different way, because you're considering it all in the scope of what is consideration paid, and then you're going to have to get through the distinct analysis to say, well, that payment is for a service, it's not for a reduction of the revenue received from the customer. So I don't have an example where it would get to a different result. I don't know if others do, but it's more of just the cost and complexity to get to that same answer.
Rich?
Yeah, Jeremy, when I looked at C, I kept thinking, can you imagine if my customer was a retailer like Target or McDonald's? Would I then have the entire US population as my customer's customer that I'd have to look at any transaction I had with them and document something so Brandon could put it in his work papers? And to me, that seemed like that was almost like a search for things to conclude they don't matter, as opposed to focusing on the ones that did. And that was just the way I looked at it, but maybe I missed something.
I had that concern too, and it makes great sense. I wondered if there was a way to put words around that, but if alternative A captures everything that you would expect within the contract, I worry a little bit about whether the customer expects it or not and notifying them, because it's not like it's one customer, it's a ecosystem of many people who they're just signing up to rent their house to someone else. But if these words, I don't know, you know better than me, if these words will allow everything to be captured, then that sounds fine.
Matt?
I would just say I'm view A. I generally, as I looked at B, in introduction of a lot of the things like, predominant and other things are going to make it probably too complex. And then I generally thought C is not operable from the start, like just because of the completeness issue and being able to work through that. I think it's going to be exceedingly difficult to get your hands around a complete population and analyze that. And so, I thought codifying A was really the way to go.
Appreciate that. Todd?
First, Paul, I agree with you. IFRS, we see a lot. Oh man. But also to your other point, it wasn't clear to Matt. We see the diversity from the user side, but it's not. I understand codifying A, and I think A probably makes sense. Are we really getting rid of diversity? It's just not clear to me from my viewpoint of, and maybe it's tightening the language a little bit to your point, or is it we're just codifying current practice?
I mean, I think the diversity that we could be getting rid of is maybe, as long as we're enforcing the registrant view, but there's a lot of arguments even with registrants, is they're actually indicating that they don't even need to do the analysis of whether it was implied or whether it was, in substance. Like they're saying, well, where does it say that I have to do that? So, I mean, that diversity will be removed. It doesn't mean that you'll get to 100% of the same answers in every fact patterns, but you should eliminate a lot of the diversity.
I guess I would have responded to that. Is the other thing I hear is the guidance to date has been TRG meetings, it's been Big Four papers, it's been SEC staff speeches, which are all non-authoritative. And this would ground us something in authoritative that, then, companies would have to consider, and auditors could then evaluate the company's consideration. And so it would be grounded more in the codification. And so I think it is going to get rid of some of the diversity. There's still going to be judgment diversity. And I think that's hard to get rid of sometimes, to be perfectly honest. And so I don't think you're going to do that. I mean, I do think it narrows the field. I was sort of just probing, and I think the people around the table have sort of walked me off the view C in terms of, are we leaving complexity somewhere where we could push it to somewhere else where the judgment was easier? I think I'm probably convinced that having sort of the view A subject to the words that I talked about that I think we all acknowledged, probably makes it easier to sort of gatekeep some things and not create too much work. And so, I guess having listened to some people, I was now probably definitively in the view A camp. But sort of acknowledging your question, it's not going to be perfect, but it should be an improvement.
Yeah, thank you, Paul. And I do think that's an important part, right? View A is putting together guidance that isn't necessarily authoritative into authoritative gap, but won't take care of all of the judgment, right? There's judgment will still exist, but I don't think judgment would go away under any of the alternatives. So certainly something to keep in mind. looking around the room to see if there's others who want to share their perspectives on this issue. Jeremy?
All right. One more question on these transactions. And I'm looking at this a lot through a platform lens, but I know it affects other industries. In the diversity of practice and everything that you've seen, is it there for transactions where the customer's customer is not paying or transacting with the seller? So it becomes a problem where it's really a who is the customer problem. I could make an argument that I'm Uber's customer. And in those situations, that's where it gets messy. But are there instances where you don't have that circle that the practice is different? Or is it only in those situations?
No. I'm fascinated at your response. So.
So I mean, your question on who is the customer, I mean, that does come up. I mean, that sometimes is a gating question to it. But can you repeat what?
Yeah. I guess it's could we not solve the problem by taking alternative C, but only applying it to situations where the customer's customer is transacting with the seller?
But in some cases, the customer's customer isn't transacting directly with the seller.
That's my question.
Yeah. So sometimes you can go through some of the examples would be a distribution chain. So I sell to a distributor sells to a customer. You make sort of payments around your direct customer, but it's clear that you're making payments in the distribution chain. So are
those not captured already in the guidance?
This is why we have this guidance,
right.
And that's why we're codifying it. So I understand your point. I just, the customer's customer doesn't automatically always transact with the seller.
Yes, no, I understand. I understand those relationships.
Yeah.
I'm just wondering if when you were looking at all the diversity in practice, if those situations are also accounting for these differently.
The direct ones where it's a customer's customer, I don't know that that's where the diversity is. I think you start to get into other situations where, it's not as clear. Like when you've got a direct line, I don't think there's I think we probably wouldn't be here today.
Right.
You get into very other specific situations where I'm making, like the finance example you gave, I'm making a payment to a bank. I sell something to a customer, I make a payment to the bank to buy down their interest. Mm-hmm. That's where you start to get to diversity. Things where the line isn't straight mm-hmm. is where the diversity exists. And this would help clean up that diversity.
Okay.
Other questions, comments? Angie?
I guess just one thing, Jeremy, reacting to a question you had earlier about whether view A in practice would capture everything we'd be worried about in view C. And I'd be interested in others' thoughts, but I think perhaps practitioners would tell you A already captures too much, I think would be perhaps a reaction we could get to the model, that there are some things that A is going to catch that you might argue feel a bit more like a marketing expense. So, sort of picture platform in the middle and restaurant on one side and Angie Storm in her TV room on a Friday night on the other side. And platform gives me a account opening credit for getting on their platform, right? That's a kind of a classic example where it's like, well, who's really, that is a payment to my customer restaurant's my customer, to their customer, Angie in her TV room. But am I platform really benefiting because I'm marketing to her to continue to use my service? So, I think there are still debates, right? And that could get real complicated too if you're in view B. But I think for the most part, there are probably some payments on the edges of these transactions that A is probably still going to catch that some would argue if you did a deep dive on exactly what the economics and who's benefiting and all that other good stuff, that it would still catch. So I'm probably less concerned that A isn't going to capture stuff than maybe perhaps captures too much, but gets most of it right and gets it mostly right most of the time.
Thank you, Angie. Any other reactions or comments? If not, it does sound like I've heard probably a majority for view A, but if you wouldn't mind humoring me and going around from an individual roll call perspective just to provide recommendations, that would be great. So we'll start with Tom.
I'm supportive of view A, and would also suggest that we either have examples or factors to consider in the application of reasonable expectation and applied obligation.
Great, thank you, Tom. And I should clarify, view A with the suggested drafting recommendations that have been provided as part of the discussion today. There we go. Perfect. So thank you, Tom. Appreciate that. Angie?
Same as Tom.
Okay, great. Todd?
Yeah, I think view A. I think this is very important, to be honest. A lot of these companies are valued as a multiple of revenue. So if we can get more comparability, I think that's a net benefit.
Great. Thank you. Matt?
View A.
All right. Brandon?
View A.
Paul?
View A.
Jeremy?
I'd rather build on view C, but as written, I think A is the best.
Okay, thank you. And Kate?
View A.
Perfect. All right. So it looks like we have a recommendation with regards to alternative A, which means we have a few other questions just for the EITF with regards to entity scope, whether or not the EITF believes that this should be required for all entities, and whether this should be required or optional, and then just feedback for the board with regards to transition or early adoption. Maybe just for purposes of this, I think that we could probably say the recommendation, right, was for this to be applicable to all entities, for it to be required, not optional. And I believe from a transition perspective, the recommendation was prospective. Perhaps there was an openness to prospective, modified prospective approach, but I think those were the recommendations from Brandon. And Brandon, is there anything else that you'd like to add into with regards to recommendations on those questions?
No, I mean, you just said it on transition. I mean, perspective seems to be the most practical. I sometimes have a hard time getting wound up if somebody wants to try to do something retrospectively, but that's all I would add.
Perfect. So maybe just for purposes of looking around the room to see, is there any EITF members or on screen who wouldn't agree with this being required for all entities, required application, and for just feedback for the board of considering prospective application as being suggested transition approach? Angie?
Paul is trying to beat me to it. It's too slow. I'm pausing on transition, to be honest. I mean, this is the revenue line. So and I appreciate it. It's hard to do retrospective, but at the same time, we are ultimately talking about a reclassification here. So I'm maybe not completely convinced that retro would be so tough. And it is the revenue line. And I sense that the implication of adopting the guidance will presumably be a drop in reported revenue. So companies are going to want to explain that anyway, I think. So if they're going to go through the exercise of explaining that, then I would prefer retro. I'd prefer retro. The other point I would make is that I seem to recall in talking with my folks that even at 606 time, trying to figure out what contracts are completed and which ones are new, and when there's a modification, is that a new contract or modification of existing contract? If you have a master services agreement, is that part of the prospective, or because it was signed a year ago, it's not? I think there could just be a lot of questions and operational challenges with going prospective.
Appreciate that, Angie. Others, Paul?
Likewise, I was struggling with perspective. I understand some might perceive challenges on retro, but this is class of transactions, and so in most cases, you're not going to have to like go literally contract by contract and try to figure this out. In retrospective, you can use estimates and materiality, and so you can get to something reasonable as long as it's you sort of cross that materiality threshold. I don't like the look of prospective. You're going to see a big drop in, or potentially a big drop in revenue. Like the trends are a mess. There's all sorts of things where people might start trying to non-GAAP stuff. I understand that we try to make things easier when we can. This doesn't feel like a situation where we're going to say that the work is too hard.
Appreciate that. Todd?
Yeah, I would agree with that. It is the top line, as by previous comment, a lot of these companies are valued based on multiple revenues, where this is most material. And if you think about how investors work, they have a whole revenue build, right? So they're looking at a lot of KPIs, et cetera, relationships, trends, as Paul mentioned. And so having a kind of a notch reaction without being able to kind of rebuild the model, so to speak, I think does put some cost on users.
Thank you, Todd. Rich?
Yeah, just curious on the retrospective folks. Are you confident that the adjustments will only go one way and they will only be a reduction of revenue? Because sometimes when we change words around something like consideration to a customer, we may find that someone had a broader definition or application than maybe the examples we put in that I've heard some people mention. And if it went the other way, they didn't have to go through that distinct evaluation that you have to go through. And so I would just ask that. I mean, there's a presumption, and if you're really comfortable with it, that's fine. But if you think it could go the other way and possibly result in a P&L change, do you feel the same way? That's all.
There's no absolute assurance. I'm fairly comfortable based on the questions we get. We're not getting many questions where people are like, I'm netting this down. Are you sure that's the right thing? Right. We're getting a lot of, I don't want to net this down. Please tell me why I have to. And so I feel fairly comfortable that the vast majority are going to be going one way. Could there be somebody out there? Absolutely. But in the grand scheme of things, that's going to be much more the exception.
Thank you, Tom.
Look, I'm supportive of modified retro. I'm not opposed to full retro, but I question the cost that might be driven in cases in which it won't matter for people defending why it's immaterial in the prior years. I would think in cases in which it is material, people are going to go back and correct the prior years. And so you're going to get the full retro effect on the modified if it's meaningful to them. So that's what's going on in my mind.
Thank you, Tom. Matt?
Yeah, I'm similar to Tom. I would add on the auditor change and consents and other different types of things that we see. So in the past when we've debated this like prospective, modified retro, I've tended to be more in I wouldn't stand in the way if somebody wanted to do retro, but I wouldn't require it. And that was probably my one question is for the people that are thinking about retro, is it required retro or is it optional?
And I mean, certainly we are interested in feedback on that, but I think we have received sufficient information, right, to be able to go back to the board with regards to the different alternatives from a transition perspective. That's one of the things that gets built out, right, in any issue summary to the board is kind of the pros and cons associated with that and analysis of how we've looked at that and other similar issues as well. So I'm not sure if there's anything else with regards to transition, but I do think it's been a very productive discussion for purposes of providing feedback to the board. Angie?
Not to add another transition option, but I think the way that in the paper modified retro is described applies to any existing contract where a customer where performance has not been fully completed as of the adoption date. So I just echo that then we have to deal with completed contracts if we go there. But one other thought, and maybe this is ridiculous because I haven't really thought completely through it, but could you do something where it's just you apply it to any payment made to a customer starting at the beginning of the year of the earliest period presented? I don't know if that ends up being exactly the same as full retro, but rather than tying it to the contract, tie it to the payment so that like you at least have a population of stuff to work through as opposed to debating whether the contract is completed or not. Just a thought. That might not really
No, and
work.
I think that would be a potential. The one thing with transition is we seem to have a lot of different options for transition. So I think you're identifying another one for considering, not having the complexity of having to go back in time, but for any new payments going forward. Yep, understood. And I think that that's fair feedback for the board. All right, but it does sound like I didn't hear any objections to this being required for all entities and being required, not optional. Looking around, everyone's nodding. So it sounds like we have a EITF recommendation for alternative A being applied for all entities and required application, and a lot of great feedback on transition that we can come back to the board with as part of an issue summary. Wonderful. That was a great conversation and really appreciate Brandon taking the lead with regards to this issue. So thank you, Brandon. All right.
I'd like to acknowledge that no one said, except for Jeremy. Usually we say, everybody says it's a great pay plan. Only Jeremy acknowledged it this time. I'd like to go on
I said
record for that for the minutes.
I did say this, Brandon.
Okay.
So at least that was on behalf of the FASB, we said. All right. So based on that, certainly just one quick, based on the recommendations, right, we will be going through and providing feedback to the board. But before we kind of close for today, and before I hand it over to Edward for a few just additional announcements, I do want to thank Allie Hinneman, this is her last EITF meeting with us, and she's wrapping up her time as a postgraduate technical assistant. She has been a fantastic team member. We have absolutely adored having her on the team. She's done a fantastic job. She will be joining Deloitte in Chicago. And we really wish her all of the best, and we look forward to seeing your future successes. So thank you, Allie. All right. And with that, I'll turn it over to Edward.
Thanks, Hillary. All I have is a quick reminder for the group. Our next regularly scheduled meeting will be Tuesday, September 22nd. And so just with that, would like to thank everybody for your active participation, and we will see everybody at our next meeting. Thank you.
Thank you. Thanks, Tom.